Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and here are three things that you need to know to start this morning. Lowe's sticks by its full-year forecast after second quarter earnings top estimates. EPS came in at $4.56 a share, ahead of the $4.49 expected. For the full year, it sees total sales between $87 billion and $89 billion. The report follows Home Depot last week. It beat the street, but posted a 2% annual sales decline. Macy's also out with results this morning. It cautioned over consumer spending later on this year. In the S&P, S&P downgrades 5 regional U.S. banks by a notch just 2 weeks after Moody's made a similar move. The agency, Standard & Poor's, dropped its rating on KeyCorp, Comerica, Valley National Bancorp, UMB Financial Corp, and Associated Bancorp. It cited higher rates and a tough lending environment for the move. Standard & Poor's says 90% of the banks that it rates have stable outlooks. And it's coming. ARM files for a mega listing on the Nasdaq. The supposed crown jewel of SoftBank's empire will be the biggest U.S. IPO this year. The offering being led by Barclays, Goldman Sachs, and JP Morgan. The British company designs chips for the likes of Intel, Nvidia, and Qualcomm, and SoftBank agreed to acquire it for $32 billion. That was back in 2016.
Well, more big retail earnings are out this morning, giving us another look into the health of the consumer, starting with Lowe's. We are watching those shares gain almost 3% after reporting a smaller than expected drop in comparable sales in its second quarter. Those sales on that basis down 1.6%. Analysts were expecting a 2.6% drop, saying it saw a strong spring recovery and online sales growth. The home improvement retailer also beat estimates for adjusted earnings per share and just missed on overall sales. And we also got second quarter results from Macy's, the department store, reporting better than expected sales and merchandise inventories down 10% compared to the year prior, helped by spring clearance sales. The retailer beat estimates on its top and bottom line. The shares, though, are down a lot this morning. And Macy's, while those numbers make it look pretty good, I think by most measures, Macy's was not great, right? If you look at the various numbers here, and particularly if you look at the forecast from the company, it says its third quarter adjusted loss per share is going to be 3 cents to a range of a loss of 3 cents to a gain of 2 cents. Yeah. Analysts have been looking for earnings per share of 27 cents.
Yeah, and if you're looking through to see what they're saying about the consumer right now, this played through in their guidance that you were mentioning a moment ago. In light of ongoing macroeconomic pressures and uncertainty on when those will abate, the company continues to take a cautious approach on the consumer, even though it did reaffirm its annual sales and earnings outlook here. Yeah,
and if you look even in the quarter, even though, again, top and bottom line beat, if you look at the individual comparable sales numbers, they're not great, right? Yeah. Macy's comparable sales were down 9.2% on an owned basis, 8.2% on an owned plus license basis. Bloomingdale's comps down 2.7%. Bluemercury was the bright spot here, up 5.8%. But Bluemercury is just a small part of the overall numbers. And something else that stood out to me was what was going on in its so-called other revenue, which fell by $84 million to $150 million. So again, a small sliver of its business. That's the credit card business. That's its store-owned cars. And there it called out delinquencies. And what Macy's says in its commentary is, we knew there was going to be an uptick in credit card delinquencies because of the macro environment, but it is happening much more quickly than we expected. Why does that stand out to me? Well, obviously that doesn't just have to do with Macy's necessarily. We should be paying attention to credit card delinquencies more broadly when you hear a call out like that.
No, it's spot on. And one other thing that caught my attention here is just the type of way that they are selling into customers here. I mean, when you hear about the STAR program rewards members making up approximately 72% of Macy's brand comp owned plus license sale on a trailing 12-month basis, that's only up approximately 3 percentage points versus that prior period. And think about the different channels that Macy's has to really make sure that they're continuing to drive more of those engagements. And if you break it out in two segments, it is in the brick and mortar division, and then on that digital side, brick and mortar sales, they were down 8%. Digital sales, they decreased 10% versus the second quarter of 2022. So what's going to change? They're going to change the capacity of how much square footage they might be operating. And that's something that also came out in tandem with this release. They're opening up even more of kind of like these mini Macy's approaches, where I think they've got a much more flashy name that they've put on it. But the square footage particularly, that's where you're going to be looking for them to provide what they're calling convenience and discovery within a 30,000 to 50,000 square feet box here, located in some off-mall shopping centers, different than the historical approach.
Right, and there's been some reporting recently that those strip malls are actually doing better in this environment than the indoor malls. To get over to Lowe's for a minute as well, this was an interesting report because, again, comps were not as bad as estimated, and the company called out its pro business, that is, professional contractors. That was a surprise to the analysts over at Jefferies, who, out with a flash note in the wake of these earnings, says that the press release from Lowe's is scarce with details, though a notable surprise is pro sales up versus the slight decline posted by Home Depot last week. We're always looking at these versus each other.
Sure.
So that's an interesting point of differentiation here, and an area where Lowe's did a little bit better this quarter.
Yeah, battle of the aprons, the blue apron at Lowe's versus the orange one over at Home Depot. But again, you think about what the management team is doing here, and I think they positioned it quite well in how they were speaking with investors, talking about making sure that they are not only improving that customer experience, but also trying to cut and reduce expenses here. CEO Marvin Ellison, CEO and President and Chairman Marvin Ellison, saying that they're reducing expenses while improving customer service, and that really being result of execution by their team. And for that effort, they are awarding over $100 million in discretionary and profit sharing bonuses to them this quarter too.
Yeah, I mean, to be sure, it's not like Lowe's is killing it here.
Yeah.
I mean, they're still seeing declines, but I think execution is probably the key word in what you were just saying. And again, to go back to that Jefferies note, the analysts there are saying nice margin management as DIY remains soft in the current backdrop. So it's just a matter of managing through what is looks like a pretty challenging period.
Yeah, and really strong inventory execution there. They talked about that and that improving as well. No doubt a major theme over the course of this retail earnings season that we've been watching here. Also, as we've been talking about earnings from Lowe's this morning, coming in a little more optimistic than its competitor Home Depot's results last week. Lowe's comparable sales down a little less than expected at 1.6%. Meanwhile, Home Depot's were down 2%. So what are these results really say about the housing market? Joining us now, we've got Cole Smead, Smead Capital Management CEO. Cole, great to have you here with us this morning. So perhaps we could start off with that question. What does this say about the broader housing market, given that you've got two of the larger DIY plus some of those larger business-to-business contracts and purchasers that take place for both of these companies?
Yeah, so we've owned Home Depot for years. We think housing has been probably the most misunderstood part of the economy looking back over the last 10 years. No one thought we'd be where we're at on housing, where tight supply, even though affordability is terrible right now relative to the last decade, is causing housing to be strong. I think what Home Depot and Lowe's have had to deal with is, as interest rates have increased, it just marginally caused people to look less to a home equity line to revamp their home and do things of that nature. That's a bigger component of their life versus just housing supply itself. Is really more to do with the home builders. So I do think the one tailwind that Lowe's and Home Depot have and will continue to have for many years to come is we've busted one of the great myths of all time, which was that millennials were never going to buy houses. And now that they own them, that's such a huge customer base to those retailers. And that those DIY companies like Home Depot and Lowe's, I think, have really good secular trends in their favor.
At the same time, housing is getting less affordable, right? In part because of what's going on with interest rates. In part, we're just not seeing much movement within the existing home sales market because people don't want to sell to pay those rates. So, are we going to have a period of more stagnation that's going to continue?
Well, to your point on supply, it's such a healthy environment. In other words, why are high rates not, causing housing to fall apart? Because there's no available homes for purchase. What are some other myths that were out there on housing? Baby boomers were going to move out of their houses and go into assisted living earlier on. That never happened. COVID proved that won't happen. They'll live in their houses till they're 90, which would be a shock to what people thought 10 years ago. So I think there's other trends that are going on in housing that are really causing that tightness. But again, unless you have the higher income from a new job or you're getting paid better to move to a new area, you aren't going to leave your 3% mortgage, 4% mortgage, et cetera. It's only based on income will someone do a move up trade or just a pure need and they have the equity to do it. That's a very healthy housing market. Go back to 07. You'll find we had the largest supply of homes available for sale that we've ever had. Which housing market would you want to be in? The one that's going to be a nightmare for years, or tight supply that looks like it's going to be a bull market for quite a long time? By the way, housing's the only good game in real estate, just so we're all on the same page. It's the only game in town doing well.
And so with what you're seeing in housing at this point in time, I mean, and I'll give you some anecdotal evidence. I went back home to Pennsylvania, at least where I grew up, and there's an entirely new kind of just residential community being built up where there used to be cornfields. And we're seeing that in several states. This is just kind of one example. And I have no doubt in Arizona, perhaps not cornfields being transitioned, but some other area where it was wide, vast, open, where new developments are popping up. And it seems like much of that could be driven by a few things in each of those markets. And all of this to say, are you seeing more perhaps new first-time home buyers saying, you know what, we'll just try and get a new home versus purchasing an existing home and then doing a bunch of the DIY renovations? What does that tell us about the housing market?
Well, there are no homes for sale. So it has to come from new supply ultimately, because someone's got to move to that new supply to make, the existing homes, up for sale. So I think, again, new supply will tell us what's going to happen in housing, whether you're Home Depot or Lowe's or whether you're Lennar and D.R. Horton. To your point, a large project out in the cornfield, to quote the Monty Python, tis merely a flesh wound. It's not changing supply at all. Here we are in Arizona. Water's a big deal. So you go look at municipalities like Maricopa, Arizona, Casa Grande, Arizona. You'll find that cities like that have water, they're growing rapidly. They're some of the fastest growing cities in America. If you go to other municipalities where you don't have water, you're not going to grow as much. So I think there are some, constraints in each market. Some markets, it's just available land. How costly is that land? In other places like the West, it will come down to water. But don't forget, when you turn corn farmland into housing, you actually use less water. It's one of the things I always tell people here. If we turn fields into houses, we got a lot more water here in Arizona.
When you're looking across the real estate industry and just trying to decide where to invest, as you mentioned, other parts are not doing so great, but there are parts like data centers, like warehouses, et cetera, that are doing a bit better. I mean, forget about office for a minute. Are there other areas of real estate that are interesting to you guys?
So if you look at the cap rates across the real estate space, it's gone from as good as it got at low rates to the largest rise in cap rates you'll ever see probably in your lifetime. So for example, use industrial. Industrial is trading at 4% cap rates. You're not going to find industrial trading at those cap rates. You're going to find them waking up somewhere closer to 5 or 6%. That's just tectonically different, because then someone going to develop new industrial has got to pay a premium to that because there's risk for the bank to have them build it. So I think that's really the trend you're seeing. Multifamily, I think if you go look at Howard Hughes Corp, they're trying to build apartments. They said, I think it was last quarter, they went to 49 banks looking for loans on a multifamily project. They couldn't get lending. That is very common. Banks are shutting lending down. Or if they are going to provide lending, you're going to pay 10, 14, 16% construction loans. So I think that helps existing assets out there, but at the same time, it doesn't help the price of those assets. There's going to be less supply in a lot of real estate arenas, but I mean, we got to swallow kind of a pig through a python here. Commercial real estate's worth a lot less. We don't really know how bad it is. We don't really know what the reset price is. We're probably going to peak over 10% cap rates in commercial office. And then the question is, what's the good properties and what's the bad properties? I was just in Seattle 2 weeks ago. Downtown Seattle's a ghost town relative to when I grew up in that town. That's very common in West Coast cities. It's very common in parts of the East Coast as well. So we have got to get through those problems. And I also think that will spill over into the banking space as we look forward 5 years. Not all banks will be affected by that, but it just goes to show you that we have real problems based on the price of money changing. And obviously that's what the Fed's doing on the short end of the curve.
All right, next time you're in Seattle, I need you to pick up some fish seasoning for me because I've been asking everybody that goes out.
I'll be there next week.
Yeah, done deal. All right, I'll write it down. Just while we're on the topic though of housing, Cole, just to bring it to some of the current events that have taken place too, and I think about the hurricanes here, about all of these different kind of severe storm systems that people
Yeah.
who are purchasing a home are thinking about even more so. Is that likely to move the needle on where people are even willing to either move and start new financing on a home project, or just move the needle at all in terms of where people are deciding to take up residence?
I think the affordability land is bigger than the weather. I mean, for example, Florida has had cheap land historically. If you look back 20 years, you always paid nightmare hurricane insurance down there. It's a very expensive thing to do. And so I don't think the weather side's a very big deal. Can you get cheap land? Back to supply. That's the supply question. If you can get cheap land, you're going to find supply grow in the region. That's why you're seeing building continue to grow in the South. That's why you're seeing, building continue to grow in the Southwest, in parts of the Midwest, but you're not seeing as much on the West Coast. You're not going to see as much in the Mid-Atlantic or the Northeast. So I think we're definitely seeing a trend of people moving. And I also think the other thing you can add into that is the work from home. It's not going to be as bad as it was in the pandemic, but we're definitely not going back to 2019 work standards. I think mothers with children that work, they're the dominant force in that conversation. And they're going to dictate to America how they're going to work and when they're going to work. And I think that's really changing housing, in my opinion.
Cole, hang on for just a second. We're going to pick up on a related topic here because you mentioned lending for some of these projects. And multiple U.S. banks were hit with a downgrade from S&P on Monday following a similar round of ratings cuts for Moody's. S&P downgraded 5 banks total, saying that large deposit outflows and elevated interest rates pose a threat to the strength of the sector's overall health. The downgrades are the latest signal to warn of slipping confidence in the banking sector. Cole, there are a couple of ways to go about this, right? I'm curious your take on buying the banks themselves, and then we can kind of broaden it out and extrapolate to what all of this means for the broader economy. But let's start with the banks specifically. Are you staying away from them right now, or does all of this concern provide a buying opportunity?
Yeah, we own Bank of America and JP Morgan. Those are the two big banks we own. We own all other financials like American Express and Berkshire Hathaway and Credit Acceptance Corporation. But just looking at banking itself, we've done a lot of work in the regional banking space. I think there's going to be a lot of opportunity. There was some, earlier this spring, but I think there will continue because the tumult that we're talking about here, it's not going to end overnight. And by the way, using the credit rating agencies, don't worry about what they say because they always tell you what you need to know after you need to know it. And I think that's what we're seeing. They're now telling us there's more risk than they thought there was. Great. That would have been really helpful like 6 to 9 months ago. So I don't think that should really cause investors a lot of inflammation. But I do believe we're going to find a lot of opportunity where there's going to be some folks that have books that are upside down and could have take unders. And there's others that as people get fearful on banking or issues in the economy, that investors could find some great opportunities to place new capital. So I think people should kind of keep their eyes wide open and keep their ears attuned to what's going on in banking because I think there's going to be some big winners and some big losers.
Does that set up for more consolidation in the sector from your perspective?
No question about it. To quote, I think the CEO at Western Alliance Bank has been quoted a lot, and we don't own the stock, but they're here local. He's asking, does the Federal Reserve want banks like them to be in business? Because really what the regulations are creating is an incentive structure that's going to cause us to have far fewer banks that are far bigger because they're just far easier to regulate, therefore. I think that's the trend. I think we'll continue to see that. We'll probably lose a third of the banks we have in America over the next decade because of the regulation that's going to be put out and the regulation that could come as well.
Well, I think we have a lot more banks, right, than other countries do at this point anyway. So I don't know. I won't opine on what's too much or too few. I don't know the answer to that. But I do want to get to the bigger sort of credit question, the implications for the economy. I just mentioned, and you probably heard in the Macy's statement talking about an uptick in credit card delinquencies. You take that, you take what's happening with the banks, you take, of course, rising rates and the tightening of credit overall. What's the impact of all of this going to be?
Yeah, you got to remember, we're coming off really low delinquencies prior to this. So you're going to see a natural uptick. Low delinquencies won't hold forever. How we look at the pulse of that, we own Credit Acceptance Corporation. They're a subprime auto lender. It's been really tough for someone like them to grow their business because if you go look at wage data, the two lowest quartiles of wages have killed it since the pandemic. In fact, the lowest has done the best. You look at the household debt service ratio, it's historically depressed going back to 1981. So a lot of these things have been in a position where consumers have had excess cash, some tied to stimulus, some tied to money they just didn't spend during the pandemic. And it's been a really good environment for delinquencies being really low. At the same time, that can't hold forever. As excess cash has been coming down, you've seen purchases change. So, I wouldn't use a retailing credit card business as the ultimate view of, what the economy is doing, because there's times where they want consumers to have marginal credit because they make money on the clothes they buy because it's a captive audience. Versus I would take a lot more credence to what we're seeing in American Express, which is you're seeing an uptick in delinquencies, but nothing that's, large levels, nothing that's, alarming for the consumer.
It's not alarming that we currently have household debt and some of the credit that's come out from the New York Fed survey, at least recently. I mean, we're sitting at what, 17.06 trillion, led by credit card balances right now.
Yeah, but relative to the economy, that's not that big of a deal. So people always go and look at the nominal number, and they never say, well, what's that relative to the size of the economy or relative to the size of the consumer earnings power? And so people always quote those big nominal numbers. They sound fantastically amazing. Again, this is a relative world we live in. I'll give you an example. One of the bigger negatives that we've heard on the consumer over the last 6 months is this idea that, when the student debt lending, starts to get repaid, the consumer is going to crater. Okay. In my lifetime as a millennial, that has been the most overplayed card I've ever heard. No one was going to buy a house because of student debt. And that's what you'd read in the Wall Street Journal back in 13, 14, 17, 18. Those kind of things have not mattered. I think, again, the risk has been that people have discounted and disbelieve. They've had disbelief in the consumer. That has been really the strength, the continued confidence, the continued momentum. What they haven't had a lot of worry about is stock prices and bond prices. And that's where we're going to see a lot of pain, because everyone thinks they're going to make their 6 to 10% return in stocks, and bonds aren't going to do that bad. And I'm sorry, it's going to be terrible the next decade. It's going to suck. And because these short-term rates will be gravity to asset prices, and the consumer is weathering that far better.
I don't know. Some of us millennials have had it tough out here. Pandemic, we'd have to weather through. A lot of us were trying to get jobs out of college.
I agree. I was there. I got out of college in 2006. The first 3 years of my career, I was like, wow, this sucks. But I would say that, no one wanted to buy a house in 10 and 11 when houses were cheap as they ever got. No millennial wanted to even try. So again, why? Because their friends weren't getting married, so they didn't. So there were opportunities left and right for millennials. The question is who took them. And, to your point, I moved from Seattle, Washington to Phoenix, Arizona in 2020. I got to arbitrage land prices. We're going to see that stuff go on. That's already going on. That's some of the trends we were talking about earlier. I just say it because, no one promised us a rose garden in this life, and we got to go out and grab it by the throat and take advantage of it.
All right. I'm just trying to get some land to put my garden on right now. Cole, hang on with us for 1 second.
Agreed.
A crude awakening. Oil prices ticking slightly lower this morning as supply concerns ease on hopes Iraqi exports will resume. China's rocky recovery is still seen as the main driver of crude. Investors remain concerned over demand from the world's top importer. Cole Smead still here with us. Cole, despite the possible easing of tighter oil supplies, you're optimistic on the oil outlook. Explain that to us. Walk us through your thesis there.
Yeah, so China used to be the tail that wags the dog, right? What China did, sent marginal commodity prices higher or lower, including in oil. And what you're seeing is just the worst news out of China. And if you don't think it's bad, it's really bad, the news coming out of China. And yet, while this news is becoming greater and more precipitous, and we're hearing about more defaults, delayed payments from financial institutions over there, you're watching oil stay tight or marginally climb over the last 60 days. So I think that really tells us a different story. It's not about China's demand. It's about the tightness of supply. The tightness of supply being that if you look at the futures market right now, you'll find that the futures curve is terribly backwardated, which means that no new supply is going to grow in the next 3-4 years because no one gets compensated to go out and take that risk and hedge it in advance. So I think that's the continued trend we're seeing is just really tight supply. And therefore, as any demand goes on, prices have to edge up or stay firm because there's no one that can produce a new barrel for supply.
And Cole, in your estimation, what is sort of the new threshold that oil would need to get to make supply more attractive for the producers who have been cutting back to start producing more?
No one asks me that question or asks us. That's a great question. The answer is a minimum $100 a barrel, a minimum of $100.
And do you see it getting there anytime soon?
We have to, because this is a growing economy and barrels per day are growing. But as I pointed out a second ago, it's just not dominated by China like it was. So you look at the Western world. The Western world's continued to grow despite all these difficulties in rates and all these inflation headwinds and so on and so forth. So we really look at it as it's $100 a minimum that you have to do that. And where you're going to get production first is from people who are already producing, where they look and say, you know what, it's profitable to go out and poke that hole in that field that we were maybe waiting longer to do. And now we're going to step up that investment. Now, where do you get a lot of big projects coming online at a later date? You're going to find those above $120 a barrel. But the rationality of the market, people used to say that, oil people will never get religion. They'll never come to know Jesus. They'll never quit drilling. Well, that's just not true. They quit drilling. And to watch an administration that loves renewables begging oil people to drill is just the oddest thing I've ever heard of. It's like stranger than fiction, which means it's true. So I think that those are the dynamics really at play in that market. And one other thing I'll add, it's got to come by Americans and Canadians, because the Europeans, it's like socially unacceptable to get oil and gas out of their ground, even though they have those resources. So we're going to see this OPEC plus, Canada, US, and parts of LATAM. That's the suppliers of oil globally.
Real quick before we let you go, Cole, how do you play this thesis on oil? Do you buy oil itself, or do you buy oil producers, or where in the stack do you buy?
We like the producers because they've just been really left for dead. And that's where the best money was made. The servicers weren't the better place to make money. So I would say you're looking for what they call torque. You're looking for places where a $5 barrel increase of oil gives you a lot of operating leverage and really grows the free cash flow of the business. So you don't want to go buy the majors, generally speaking, because they don't provide a lot of torque. Go look for names that have been more affected by things like gas. We own Ovintiv. They have a higher gas mix. Apache would be another name that I would throw out to people in that space. And then if you go out look in Canada, the Meg Energies of Canada and, the Cenovus's that get WCS, a $5 increase in WTI directly affects Western Canada Select blend as well. So you'll see the Canadians will really outpunch their weight as we move forward here because they have more torque than a lot of the American players as well.
Cole, thanks for spending some time with us this morning. If you go back to Seattle, you can get the fish seasoning for Brad, but I'll probably be there first. So,
as long as somebody picks it up for me, we're good.
Thanks, Cole.
Yeah, I missed Top Hot Donuts. That's what I need is a Top Hot donut. So
I don't know that those will make it back with me. Cole Smead, Smead Capital Management CEO. Thank you so much. Appreciate it. Well, big news. SoftBank's ARM has filed for an IPO. That happened late yesterday, snubbing the London Stock Exchange for the Nasdaq. Information does continue to trickle in about the chip designing company and its upcoming listing. It will be the biggest IPO in the U.S. since Rivian in November 2021. Let's bring in Yahoo Finance's Dan Howley to discuss more. And this is a really interesting company, Dan, that has been around for a long time, has switched hands. Nvidia didn't succeed in buying it a couple of years ago, so now it is going to be making its public market debut.
That's right. Yeah, Nvidia tried that $40 billion takeover, got shut down by global regulators. And so, yeah, this is where we are. We're seeing ARM file for the IPO on the NASDAQ. The revenue for the last year was about $2.68 billion for the company. And just to, as you said, it's an interesting company. This isn't like TSMC or Intel. They don't build chips themselves. What they do is they design chips and then license those to other companies. We're talking about Apple, Samsung, Qualcomm, any kind of company that offers a mobile phone or tablet probably is using a ARM chip or an ARM design chip. They're increasingly trying to move into other areas. Those include things like laptops as well as servers, though that's pretty limited as far as their overall share goes. They're more focused on the mobile side of things. So, as much as we'll see them talk about low power compute, That's something they talk about when it comes to the laptops and desktop kind of thing. It really is still all about mobile phones for them. And so, this IPO is coming at almost a strange time as we're seeing this slowdown in smartphone sales across the globe. Apple warning about a slowdown. And so, and that's even going into a quarter or two where we'll start to see the impact of the newest iPhone. So we'll have to wait to see what that looks like in the coming months, just as, we potentially see people start to pick back up in purchasing those devices. But for ARM, it does come at kind of an off time for the market.
Wow. All right. So we're going to be watching that one closely. Dan, stay with us for a hot second here. We want to hit on one more big deal this morning. Across the pond, Microsoft is still pushing to gain the United Kingdom's approval over the $69 billion U.S. merger that was first proposed in 2022. So still with us, we've got Yahoo Finance's Dan Howley. Dan, what can you tell us about this latest push for approval in the UK?
Yeah, this is kind of a strange kind of move on Microsoft's part. Basically, what they're saying is they're ceding the rights to their the ability to stream games to competitor Ubisoft. Microsoft, obviously, they make the Xbox console. They have the streaming service. Ubisoft has its own streaming service. They also publish their own games. So they're a friend and foe at the same time. So what happens here is that Microsoft would the games that would be on the cloud would go to Ubisoft. Ubisoft would pay Microsoft a one-time payment and then royalties for games. Then Microsoft would have to license them back from Ubisoft to themselves. Ubisoft would also be able to license them to other cloud providers. That's with the exception of the EU, where the existing kind of rules that they put in place around this deal would continue to remain. So Microsoft essentially saying, look, we want to be able to stream these games. We want to be in the cloud streaming market, but we won't abandon this deal if that's what if it means keeping cloud streaming. So they're still going to be able to do this. It doesn't mean they won't be able to do things like stream Call of Duty. They'll just have to go through Ubisoft to be able to do it. But when it comes to Ubisoft, I mean, look, I think that Microsoft is the larger player here. I mean, clearly, so as far as the competition that they have to offer to Microsoft, it's not going to be that big, but this will give them a nice boost as far as the overall gaming market goes. And cloud gaming is still very early on. This isn't something that, you would talk to most people. How do you play games? They'll either say on mobile, whether that's, just regular old mobile games or on a console or PC. Then they would say streaming games. So this is still very early. This would happen for the next 15 years, this deal between Ubisoft and Microsoft. The games that happen in the interim in those 15 years would be licensed to Ubisoft in perpetuity for the cloud. But yeah, I mean, look, this is something that's going to potentially get the deal across the threshold for Microsoft. I think that's what they're most interested in here. Don't forget, they're still trying to really dominate the mobile side of things with the cloud. So we'll see how this all kind of plays out.
So will this make gamers happy at the end of the day?
I think it will. I think it all depends, right? Because Microsoft is now going to have to work to get the games from Ubisoft onto Xbox Game Pass, which is their cloud streaming offering, or the highest level of the Xbox Game Pass. It'll also be available on PlayStation. Sony can also license them, and Nvidia can also license them. So it'll be available in more areas. It's not necessarily going to be as though it's cut out, but companies still, Microsoft, Sony, still have to try to get these games on their consoles. So the fact that they have to be now working to get them on their cloud streaming platforms, that might be a little annoying to gamers. But I think, look, the more access that they have, the better in general.
Well, I believe October 18th is that deadline, so we'll see if this ends up getting approved by then. Thanks so much, Dan. Appreciate it. We just had the opening bell on Wall Street, so let's do a quick check of where we stand. We've got the Nasdaq leading again, up 0.7%. The S&P up about 1/3. The Dow taking a bit of a hit, down 0.1%. In about 30 minutes or so, we're going to get existing home sales. We were talking a lot about that with Cole Smead a little while ago, the housing market. Of course, people are looking ahead to Jackson Hole on Friday and Jay Powell's speech at that point. And then we still have some retail earnings that we are sifting through. So all of that having an effect. What are you seeing sector-wise?
Yeah, I'm taking a look at some of these sectors here. It's crazy. 11 S&P 500 sectors, right where we left them here. As a consumer staple watcher here, I'm seeing that down by about 0.5% to start off the day. And that is as you've got some mixed activity, about 4 laggards, and you can do the math on the decliners, 7. But leading the pack right now, you've got technology and consumer discretionary. So we'll see exactly where that nets out as we move on throughout the rest of today's trading session. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
We've seen the S&P 500 pull back a little bit from its highs, around 2.5% or so. How deep do you think that drop could be?
Yeah, if you'd asked me a couple months ago, could we get back to the lows that we saw at the end of last year? I'd say maybe. I don't think that's going to happen now. Maybe another 5% pullback or so to consolidation phase, maybe around 4,300 on the S&P.
Welcome back. Dick's Sporting Goods shares, they are plunging today after the retailer saw a 23% drop in profit, lowered its guidance due to an increase in theft, which the company's CEO called an increasingly serious issue. Adrian Yee, Barclays consumer discretionary analyst, joins us now. I have a hard time believing that anybody's sneaking tailor-made drivers out of Golf Galaxy, Adrian, but perhaps Dick's knows something that I do not. Take us through your read on this quarter.
So the read on the quarter is that demand is still there, right? They came in at 3.22 billion. The consensus was 3.24 billion. The composition of that, they actually missed the comp. So the comp came in a little bit light, and it was, it was 1.7%, and it was entirely and then some driven by transactions, right? So transaction count, which is great, was up 2.8%. That then implies, right, that average unit retail was actually down. So during the quarter, we love to look at promos, and they were very promotional, which is very similar to what we've been seeing for the past 3 or 4 consecutive quarters. And at the end of the day, they're in an investment cycle. So what do we always say about when sales are going out? It's really hard to be very, very long and aggressively long sort of companies that are going into an investment cycle, that have been doing well, that are kind of counter to the trend, and that people are already long. The trifecta.
Adrian, it's Julie here. So where are we then in that investment cycle? In other words, when's it going to start paying off in a bigger way?
We're in the earlier stages of it, of a multi-year. So they opened 7 House of Sports, and that is the banner that is sort of the experiential banner. It is the direction of travel of the consumer, right? So kind of getting away from just a place to shop, we're to a place to experience, search, find, and actually play sports, right, in these House of Sports in some regard. And so that is the right direction of travel. They expect to open over a period of multi-year period, 75 to 100 of these stores. But in the meantime, right, we always talk about early non-comp sales. You don't get the full kind of sales productivity out of that box until they mature over a couple of years. This is the right thing to do. When companies have excess margin and have been doing well, you absolutely want to see them go into investment phase. But it's a painful part of the cycle until you get to the harvest phase.
Adrian, some of the interesting things we've been watching over the past 2 years especially, and some of it driven by the pandemic, is the types of sports that people are playing and the new sports that have come about. I mean, we've seen the game of golf grow. We've seen, and as people are looking to get more into outdoor activities, we've seen games like pickleball just absolutely skyrocket in terms of fanfare. And then you could add on kind of an assorted realm of other sports as well that Dick's would be able to capitalize on. But if that starts to normalize in terms of the growth, what does that mean for Dick's?
I think it's okay because the athletic sporting arena, as you just mentioned, right, during COVID, you had a lot more participants, not only in the adult, millennial, Gen Z, but a lot more participants in the early stages, younger kids entering a more healthy lifestyle. This is a generational trend. So the secular growth of sporting goods, athletics, that is definitely stronger post-COVID than it was pre-COVID. I would also say that even if that normalizes, right, during the kind of period, unfortunately, of COVID, Dick's is one of the, if not the only last standing national sporting goods retailers. Everybody else is sort of regional, and there are a lot of mom and pops and independents that did not make it through this period. So to the extent that they are sort of the 800-pound gorilla in this space and the best execution, right, of this kind of sporting goods play in a secular growth, that's all good for the long term. It just, in this kind of like margin, kind of profit reset, right, you got to take a little bit off of these peak margins that they benefited from in this cycle, take it a step back, normalize it, and then rebase, and then grow from there.
Adrian, it seems to me opening these new concepts is going to require some more experienced staff as well. And just on a personal anecdotal basis, when I go into a Dick's, there are not enough people in that store. And I wonder how they're doing. You mentioned there's not another national chain that's really comparable, but I do think of the likes of an REI. Yes, it leans more outdoors. But if I go into an REI, I know I'm going to be able to talk to somebody who knows the product very well. I don't have that same assurance from a Dick's. Is there a market share situation happening there at all? Or do you think of REI sort of in a different category?
So, Julie, what I would say there is, if you think about a pyramid structure, right, and you think about kind of broad and shallow, sort of, which would be more, and a lot of expertise, a lot of customer handholding, right? That's really on the REI side of things. And then as you kind of widen out that base, right, kind of the volume drivers, right, sort of more to the masses, that's what I think of more sort of as Dick's Sporting Goods. And so I think they play in different parts of the competitive structure. Bear in mind, REI is also a private company, so we can't see exactly what's going on there. But I too agree with you. When you want that expertise and you want to buy that perfect pair of hiking boots for that, Mount Everest climb, you're going to the professionals, right? And that's sort of REI. And so I think of it a little bit kind of as two different market segments. REI plays in a smaller segment, Dick's in the bigger segment and more mass oriented. Doesn't necessarily mean there's not overlap, but I do agree with you about the kind of the customer experience. It's a big store. There's a lot of things in there. And I think you're right that, there could be a little bit more investment in payroll over time.
Adrian, you've got a lot of people who are watching right now, taking a look at these charts, seeing Dick's Sporting Goods shares now in negative territory for year to date because of today's move here. When you think about whether or not investors who are thinking about whether or not they should be buying this Dick's dip in this stock right now, what word of advice would you give them?
I would say just take a pause. Their inventory is clean, so their inventory is very clean. Sometimes clean inventory prevents acceleration of sales because there's not as much to sell in terms of units. We upgraded the sector about a couple of weeks ago, and our upgrade was placed on the beta trade, the ones who are sitting on the low margins, not the high margins. And so if I'm recommending and advising people on how to play the consumer discretionary space in 2024, because we know that there's pain going on from all these Fed hikes and inflation, that will persist all the way through the back half, this critical sales season. So the real clean year to own this is 2024. And we would really kind of go more toward those who are sitting on low margins, perhaps a GPS, a Gap, which we will find out, perhaps an American Eagle. Tonight, we're going to hear from Urban, great checks at Urban. So we think Urban's a place, URBN's another place to if you want to place money right now for the back half, those are the types of names. And for sure, the off-pricers, TJX, Ross, Burlington.
Very interesting stuff. Room for upside, I guess, is what people need to focus on. Adrian Yee, Barclays Consumer Discretionary Analyst. Thanks so much. It's always great to talk to you.
Great to talk to you.
Take care,
Thanks
Adrian.
for having me.
Thanks. Well, Pfizer's vaccine, moving on to another mover, Pfizer's vaccine to protect babies from RSV has officially been approved by the U.S. FDA. It's now expected to be available in the third quarter of 2023. Yahoo Finance's Anjali Kamlani joins us now. And the shares are not moving much, I guess because this was expected at some point, and also because we're not quite sure what the outcome is sales-wise now, right?
That's right. While it is expected that there will be some uptake for this RSV vaccine, it isn't as, say, a big mover the way that COVID was for the company. So this vaccine is a similar formulation from the one that was just approved for adults older than 60. It is meant for pregnant women who are between 32 and 36 weeks. That's when they receive the shot. And it protects their babies up until 6 months after being born. Now, this is something that really affects the younger and older populations more. And this vaccine specifically for severe illness, not milder infection. So really under 5 years and over 60 years of age are where you see the most hospitalizations and deaths, and impact. Up to 2 million kids under the age of 5 are impacted every year by this. So it is a concerning one. But as you mentioned, not so much a driver for them. Now, we do know that, of course, they're planning to launch the 60 and older drug in Q3. And there's a question mark on when the maternal vaccine will be ready because the CDC has not yet signed off. There is a meeting slated for October, which is when that decision could come through. And because the two doses are the same, Pfizer has already been producing these doses, and so it should be ready to get off the shelves as soon as the CDC gives their green light. So that's where things stand for that right now. Definitely welcome news, of course, for the younger population. But as you mentioned, it's a question mark for Pfizer.
Anjali, well, we've got you. We've got another question mark for you. In other news, Novavax is saying its vaccine protects against new COVID variants. What can you tell us there?
That's right. Novavax just confirmed what they'd already said, which was that their vaccine, the latest one that's going to be updated and authorized if the FDA gives it the go-ahead for later this fall, is protective against the new variants that we've seen circulating. That is part of that Omicron family, including the one nicknamed Eris. So we know that as of right now, across the board, the three vaccine companies that are planning updated COVID vaccines, so that's Pfizer, Moderna, and Novavax, have all indicated that they're going to be ready for the XBB variant that they were initially formulating for, and then the new ones, all again part of the Omicron family, so should be protective even with the immune evasive properties that we're seeing.
Thanks, Anjali. Really appreciate it. Moving on to one last mover that we're watching. BJ shares this morning. We're watching those after the retailer slashed its full year guidance as it struggles to adapt to cost-conscious consumers. The shares down almost 2%. BJ's previously expected a 4 to 5% increase in comp sales for the year, but now it's anticipating only a 2% rise. And as we try to get a more complete picture of the consumer right now, this one's a little confusing to me, I would say, because we were just talking about, we've seen with Walmart that people are trading down. Adrian was just talking about off-price doing a little bit better in this environment, people wanting to save money. One would think that BJ's would also be benefiting in the same measure.
Yeah, bulk buying is typically one of those hedges that many consumers will tap or will lean into. What I think is one of the interesting dynamics that we've been watching with BJ's and with Costco is where they're making sure that the membership fees are something that's going to help them in this interim period sustain perhaps where there is less of a buying propensity or the lack of new members here. Now, what's interesting for this company is they're also leaning more into that digital side too, and that's what you're going to hear more from the wholesale club companies, whether it's Sam's Club, whether it's BJ's, whether it's Costco. They're trying to beef up that digital offering as well in Touchpoint. Digitally enabled comparable sales growth, that was 15% year over year, and you think about where the comparable club sales, including gasoline sales, that was up by about 1.1% year over year. But just rounding this out with that membership fee, that income, that increased by about 5% year over year to $103.7 million. So, even as we kind of compare these companies back and forth and figure out who has the better kind of membership fee structure or who's, helping customers hedge against inflation by offering a $1.50 hot dog. I think at the end of the day, for those members really seeing the value and how much they're paying for that membership fee and the cadence of visits that they are making for the basket of goods that they are purchasing, I think that's where it gets more interesting to hear what the state of the consumer is from companies such as BJ and Costco's right now.
Yeah, and I was just looking through some of the analyst commentary here, and I should mention BJ's is still projecting a gain in comps for the year. It didn't go too negative, and it seems that much of the analyst community was expecting this guidance cut. So while the shares are down, they're perhaps not down more because there was at least some expectation that this was going to happen.
And an acknowledgement of investments. We heard that from Adrian Yee, talking about Dick's specifically within that regard here. And BJ's Wholesale Club Chairman and Chief Executive Officer Bob Eddy said within this release, they're continuing to balance gross margin with investments in value and growing the size and quality of their membership with an eye towards the future as well. So we'll look to see where those investments net out. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What is your favorite chart or indicator that you're watching right now?
Well, I think I'm watching jobless claims. This is something that is very immediate, and this is something that is really a good real-time indicator of what is happening in the labor market, and the labor market is what we need to really focus on. As inflation is declining, the Fed will be watching the labor market much more closely.
Investors are eagerly awaiting Nvidia earnings after the bell tomorrow. The chip maker blew away estimates in its last report. We'll see if they can do the same here. The stock sits up over 200% so far this year. But is more growth still to come? Yahoo Finance's Jared Blickery. He's joining us live in living color from the floor of the New York Stock Exchange. Hey, Jared.
Hey, just enjoying the Technicolor here. Got to talk about Nvidia. Is it encroaching on Tesla as one of the top stocks in the universe? One of the big sentiment indicators, Apple already in that group, and Nvidia giving Tesla a run for its money, just in terms of expectations, bets, and we're looking at the options market. $100 billion has been placed so far on Nvidia in the options market, second only to Tesla this year. And then you take a look at what's happened not only in the options market, but the underlying as well. The last earnings report, they were up $184 billion in one day. And I got a tweet here from Jim Bianco about how important Nvidia is becoming to the overall market, the S&P 500. So he's saying yesterday the S&P 500 was up 0.7%, and then of that, Nvidia was responsible for 34% or 1/3. Tesla was responsible for 19% or 1/5, and then the entire Magnificent Seven, all those big mega caps, 94%, and then the other 493, 6%. So arguably, Nvidia just gangbusters here. If I can go to the Wi-Fi Interactive for a second, I'll plot the year to date. Over the last two sessions, we have really just climbed right back up to this consolidation highs here. And if we get a gangbuster report tomorrow, you can bet we're going to just surge above that. And if not, I wouldn't be surprised to see 400 back in play.
Oh, interesting stuff. We are also, Jared, tracking China stocks, which are seeing a bounce back today. What can you tell us there, and how sort of significant is that?
Well, first of all, stocks are bouncing back a little bit. If we go to the Wi-Fi Interactive, I will chart the Hang Seng, and over the last 7 days, this is actually overnight. You can see we got this big spike here right after the lunch hour, after traders resumed trading. That was largely unexplained, but over the last 7 days, you can still see down almost 7% in the bottom end of the range there. I'm going to call this an oversold bounce. I don't think this has a lot of significance for stock traders, but there's a lot of other things that are happening with respect to the Chinese economy and that are being done by the monetary authorities to stimulate the property markets there and to stop what they perceive as a deflationary spiral. Now, if I go to a chart of the Chinese yuan, we're going to see that it has actually been weakening quite a bit. This is over the last 3 months, and we are right back up to these highs. The government fixed overnight the rate at 7.2%. It's right back up to 7.3%. That disparity where they're trying to take it a little bit stronger is the biggest since Bloomberg started covering this data in 2018. The point is the government cannot have a runaway yuan just weakening and weakening, because that promotes capital outflows. They don't want to lose all the dollars in their currency. So they're making it more expensive to bet against the yuan along with other measures. But these are only piecemeal. Put together, are they going to do the job? We're going to have to see, guys.
Yes, we will. Thanks so much, Jared. Well, possible government shutdown is looming large again. Members of the House Freedom Caucus are making it clear that without an agreement to certain terms, they will oppose any spending bill. The group released a statement saying, "We refuse to support any such measure that continues Democrats' bloated COVID-era spending and simultaneously fails to force the Biden administration to follow the law and fulfill its most basic responsibilities." Yahoo Finance's Rick Newman joins us now with the details. We're already doing this. This is separate from the debt ceiling.
Don't blame me, Julie. Just the messenger here. Right. This is not the debt ceiling all over again. This is not as serious. And, honestly, I think everybody should just ignore this. Let the members of Congress who want to fight over these things have their little fight. And then we'll maybe get back to governing in October or November. But for what it's worth, there are about 30 members of this super conservative group called the House Freedom Caucus. They're all Republicans. They say they are not going to agree to the spending that's needed to continue government operations after September 30 unless they get concessions on this list of things you see there. They want tougher border security. They actually want the Biden administration to start rebuilding Trump's border wall, among other things. Less spending. They're worried about social issues at the Pentagon and so on. So what's probably going to happen is let's call it a 50% likelihood there's going to be some kind of government shutdown, which would happen beginning October 1st. That's when the fiscal year begins. And then these guys have to figure out how to fix this. Now, there are enough Democrats in the House that they could provide the votes that the House would need, along with the Republicans who control the House, to approve spending bills. But they're not going to do that unless they get everything they want, and that's unlikely. So we're going to just get to this showdown. It's not going to affect markets very much. It's not about whether the U.S. can continue to make its debt payments. It's just another one of these silly fights in Washington.
Rick, thanks so much for breaking this down, tracking this so that some of us don't have to every single day. But nonetheless, great to hear some of the updates from it. Appreciate it, Rick.
Bye, guys.
See ya. Well, we've got some breaking news here as we're tracking existing home sales, and it looks like July existing home sales, they fell 2.2% for this most recent reading here. We had a pretty fleshed out conversation earlier in the show just about what the market is and the environment for home sales, and where particularly buyers that are out there are just looking for any inventory to come online. And that's where we're hitting a supply issue, as was explained to us by Cole Smead, CEO of Smead Capital Management, earlier.
Yeah, so this decline here that we are seeing in existing homes, I mean, you know, people don't want to move out of their homes because they don't want to pay those highest interest rates. So that obviously is an issue here. Looking at some of the other stats that we're seeing on an unadjusted basis, the drop in sales was more than 18% year over year here, as we have these mortgage rates that are above 7%. So if you are going to put your house on the market and move into something new, you're going to be paying much, much higher interest rates, chances are.
Yeah, and I think looking across the spending propensity right now for anyone who's looking to get into a home, new or existing, you're kind of comparing, okay, what exactly in an area of the country am I going to be getting? What's that delivery look like if you're in that new home mind frame? But for the existing side, you know, just as you were mentioning, if anyone who is, and for a lot of the existing home sales that we had seen even going into or mid-pandemic, where financing was ripe for the taking, and people were looking about how we could purchase an existing home, perhaps Airbnb that out, create an additional investment opportunity. Now you've also got to monitor what the actual spending or experience spending environment looks like too. And if less people are moving towards renting an Airbnb versus going into a hotel and whatnot. So that makes even the investment realm a little bit more shaken if people were looking at purchasing an existing home right now. So continuing to look through the wires here to see what more we could take out of this.
So a couple of interesting stats here before we leave you. Number of homes for sale rose month over month to 1.11 million, but that was the smallest inventory of homes for sale for any July, specifically going back to 1999. So that just gives you an idea of the tightness of the inventory here.
All right. Well, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Fed officials descending on Jackson Hole next week for the Kansas City Federal Reserve's annual economic symposium will face the question of whether inflation is on a convincingly downward trajectory or whether more interest rate hikes are needed to bring down inflation. Inflation has cooled on a headline basis from a peak of over 9% last June to just over 3% this July. But stripping out volatile food and energy prices, inflation sits over 4%, double the central bank's inflation target of 2%. In his last comments at the Fed's policy meeting in July, Fed Chair Jay Powell wasn't convinced on inflation yet to let off the gas and said he needs to see leftover distortions from the pandemic on supply and demand ease.
Policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate.
Traditionally, Fed chairs have used their speeches at Jackson Hole to put forth major policy messages. This year expected to be no different, with investors hanging on Powell's every last word.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the trading day, 37 to be exact. Let's take a look at how stocks are moving. We'd like to be precise here this morning. Stocks looking for direction, though, this morning, with buzz around Nvidia's results tomorrow and some solid reports from retailers this morning. Could a burst of optimism turn the summer sell-off around? Also adding to the excitement, SoftBank's ARM filed for Nasdaq listing last night in what would be the biggest initial public offering of the year.
Let's look at some individual names. Emerson Electric is on our list. It is up by about 1.2% today after JP Morgan upgraded the stock to overweight from neutral and raised the price target to 107, seeing about 13% upside. The analyst saying the engineering company is poised for a turnaround as it makes long-term investments towards growth.
And we're also watching Coty this morning. The CoverGirl parent topped revenue estimates in its latest quarter as customers splurged on makeup and fragrances, but forecast lower than expected annual profit. It's being hit by higher labor and material costs that could not be completely offset by raised prices.
And shares of Baidu on the list as well. They're up a little more than 4% after the Chinese company reported a 15% jump in revenue compared to the year prior, beating analyst expectations. Baidu citing a growth in advertising for driving the growth in sales, even amid the increased turmoil in China's economy. Baidu has also said that its ChatGPT rival, ErnieBot, is outperforming on many levels, so investors will be watching the tech giant's AI ambitions very closely. Well, speaking of China, confidence in that nation's economy is waning as the country struggles to bounce back from the pandemic-era slowdown. Falling property values, retail sales, a strained relationship with the West are all weighing on the world's second-largest economy amid a deflationary environment. Today, perhaps in an attempt to send an olive branch, the U.S. lifted restrictions on 27 Chinese companies and organizations ahead of Commerce Secretary Gina Raimondo's planned trip to Beijing this month. Our next guest testified before the U.S.-China Commission yesterday, speaking to China's troubled economy and its global expansion plans, including its influence through its sovereign wealth fund. Joining us now with some insight into this is Zoe Lowe, who is Council on Foreign Relations International Fellow. Zoe, thank you so much for being here.
Thank you, Julie and Brad, for having me.
So I guess let's start very big picture. What should we make of the current troubles in China's economy? How severe are they? And thus far, it doesn't seem as though the PBOC or policymakers there are willing to really throw everything at it in terms of stimulus. Is that going to continue to be the case? I know a lot of questions in there, sorry.
Right. So let me just take a step back by explaining the current turmoil, how to interpret that, and then move on to talk about where the appetite is in terms of stimulus. I would say that actually a lot of the problems that we are observing today in the Chinese economy has been a systematic accumulation of problems that are embedded in the growth model. And I characterize China's growth model rather than export-driven or government investment-driven, but instead I come down where the money comes from. It's really about financial repression. The model has been built upon financial repression, and that literally means it is against or anti-household consumption. So now we are talking about extending the drag of household consumption on the economy, which is literally why when economy numbers is not necessarily good, job numbers is not necessarily good, people start not to necessarily want to spend, but rather saving. And this also moves down to what extent the Chinese government is going to give stimulus checks, for example. I do not see the political appetite there. Perhaps right now the top concern is how to clean up the local government debt.
And so is there anything that would signal to us that there is a stark shift perhaps in that consumer sentiment or in that consumer propensity to spend, given that there has already been issues around or concerns around data transparency? Is there anything that we can look towards to spell out where that shift is coming from?
Right. Brad, that's a good point, because if we look at a consumer confidence index, it's not that the Chinese government stopped publishing it or stopped updating it since April. If we look at last April to the last time we updated it, during this 13-month horizon, only January to March, these 3 months, consumer confidence number was above 90. And for most of the time, it was even below 90. And that was unprecedented because when the Chinese economy was growing during the roaring double-digit growth period, consumer confidence index has always been above 100.
Wow. Okay.
When we look at what happens next for the Chinese economy, I mean, for years there had been predictions that it would overtake the economy of the U.S. in size. Is that still going to happen?
So, that's that question. I wish I have a crystal ball there, but I'm increasingly suspicious in terms of to what extent China can surpass the U.S. economy. Because if we just look at a per capita number, obviously China has too many people, anything divided by 1.4 billion is going to be minimum. But I still see China's growth potential in the long run, but what really is constraining the Chinese growth potential comes from both economic fundamentals that is related to the financial repression growth model, and then the other aspect is geopolitics. And a lot of these really create deflationary pressure, both from domestic and from international. And the deflationary pressure right now, we say, probably, there is that argument to be made. The current deflationary pressure could potentially be transitory because, in particular for the consumer price, it was because of a significant drop in pork price. Therefore, price overall at the aggregate level went down. But if you look at, if the politics is right, meaning if President Xi Jinping stopped measuring policy swings, if he took the initiative to warm up relationship or ease the relationship with the West, perhaps uncertainties and the risk would de-escalate. Therefore, Chinese household would not be thinking about what if there is a war and my individual economic security is going to be subject to military conflict, whether it is Taiwan or something else. So they might be incentivized to spend, or for that matter, international companies would continue to invest in China. Other than that, I would still think the cloud over the Chinese economy from geopolitics side is still going to be deflationary.
And so what is that? What is the state of international companies investing in China? Because if you listen to earnings calls from companies like Starbucks or like Apple, they'll continue to talk about how core of a region to their growth ambitions that Greater China is. And of course, that kind of looks across how they break out their regions, but more specifically, they speak about China. And so with that in mind, what is the state of the investment? Because they would say, yeah, this is key to our growth, but at the same time, there's something different at play from what you're spelling out here.
I mean, again, this comes down to the size of the market.
Sure.
And for a long period of time, 1.4 billion is a big market for any consumer-based company, whether it is Estee Lauder or Starbucks, it is a big market. And related to that, the taking a long position on China, there is also the aspect of, well, there is rising middle class, right? And they are increasingly willing to spend. But the problem right now is the middle income families, they are not necessarily incentivized to spend. And part of the reason is because income growth over the past 10 years have declined, and at household level. And then on top of that, job prospect is also declined, coming from both state employers as well as multinationals. Unemployment number latest is about 21.4%, and now stop updating. If we compare China's youth unemployment number with OECD level, OECD is about 10%, and 21% is only narrowly characterizing urban dwelling youth aged between 16 and 24. Now you realize, well, at the aggregate level, perhaps youth unemployment is even higher. So from that perspective, I really think China, yes, it is a big market, but perhaps in the midterm, in the short run, at least now, as long as President Xi Jinping's policy does not change, probably the market outlook is not necessarily good. But longer term, probably still positive.
Today, President Xi Jinping is in South Africa,
yes,
meeting with that nation and participating in a summit there. As we see these economic issues in China, will China's international influence in regions like Africa decrease?
Julie, that's an excellent point. And I think given China's domestic slowdown, and compounding that tension with the West, seems to be continue escalating, or at least is not abated. So in this broader context, domestic and international, I would think President Xi Jinping, in order to expand the market for Chinese companies and find a new growth engine, perhaps, and also on top of that, sustain China's comparative advantage in the clean energy transition. China would still want to have expanded interest in Africa and Latin America, and perhaps the Gulf Cooperation Council member countries. And the reason is because there are three reasons. The first reason is really about the geopolitics, because the BRICS group, as well as the Shanghai Cooperation Organization group, these are China-led, non-Western, has nothing to do with the United States or the European Union for that matter. It's not just loose association or partnership, but there is a geopolitics argument to be made from two perspectives. The first part is hedging against sanction, and given what happens in Russia and all that Western collective sanction against Russia, in particular seizing foreign exchange reserves or frozen foreign exchange reserves, China actually has the largest foreign exchange reserve in the world, more than $3 trillion. So from that perspective, Xi Jinping would have all the incentive to build an alternative system that is not centered around the dollar, to diversify or hedge against the risk. And the perfect vehicle would be through BRICS and the Shanghai Cooperation Organization. And then the second part of that is related to energy transition. If you look at the Shanghai Cooperation Organization, these are a group of countries that are major natural gas exporters. You have Russia, you have Central Asian countries, you also have Iran join. And now the interesting part is Saudi Arabia. Saudi Arabia is interested in joining not just the BRICS, but also Central Asia, the Shanghai Cooperation Organization. Now you realize, well, China seems to be playing a very important role in the energy market towards the transition. And natural gas is going to be a transitional fuel. And then finally really comes down to trade. Given that, right now China's trade number in July is double-digit percentage decline. And compounded with, related to that, U.S. import from China actually declined. So where is China going to export?
Right, yeah, exactly. So all of this combined showing it's a complex mosaic, I think, is my takeaway. Zoe, really fascinating stuff. Please come back and see us again. Zoe Lowe is Council on Foreign Relations International Fellow. Thank you.
Thank you for having me.
Thanks. We got much more coming up. You're watching Yahoo Finance.
The jobs market's going to continue to slow, and that's good news, paradoxically. I mean, the Federal Reserve is trying to engineer a soft landing. We're seeing leading indicators for the job markets weaken, which suggests that the job growth in this country is going to moderate.
August is Black Business Month, and we're taking a closer look at one of the biggest hurdles facing Black business owners, access to capital. Black-owned businesses secured around $2.25 billion in funding last year. That is just 1% of all available capital, according to data from Crunchbase. Efforts made in recent years to support Black business owners have been effective, but only temporarily. 2020 saw a surge in support for Black founders and startups during a reckoning sparked by the murder of George Floyd, but the boost sharply dropped off the following year. Though macroeconomic factors slowed VC funding in 2022, total capital fell 36%, while Black businesses saw financing fall by 45%. Kelly Eiffel is the founder and CEO of Guava. It's a digital banking platform designed by and for Black small business owners, and she's here with us in studio. Kelly, thank you so much for being here.
Thank you for having me.
So let's talk about the sort of capital raising journey for you and what it has looked like.
Yeah, it has been really arduous, I think, for most people, as you just talked about. We raised a pre-seed fund last year, a pre-seed round last year, and I talked to hundreds of investors. We have a few investors that are really supportive of Guava and of me, but the experience is a rough road.
So tell us a little bit more about Guava and what you're looking to do, how you differentiate from what is the typical banking experience.
Yeah, so the way that we think about Guava is a kind of small business growth platform. And so we provide all of the resources necessary for traditional or kitchen table businesses to build and grow. That started with a commercial bank account, so making it really easy to access financial services like a checking account. And then we've expanded now to Huddle, which is our community platform that brings all of the resources, the auxiliary resources, so the networking, the expert office hours, the coffee chats, the lawyers, the accountants, all to bear so that entrepreneurs aren't Googling for things and making unnecessary mistakes.
And so it sounds like that your audience is also different organizations that might have a tough time having access to capital, right?
Yeah, Guava's members are small business owners that are starting out. Often they are, like I say, kitchen table businesses is something that we like to call them, but you think of someone that's doing taxes on the side or making candles in their kitchen and really thinking about that as their entrepreneurial starting point. And so we come in as a way for us to support them and not having them be by themselves. There's not that many resources for entrepreneurs that aren't venture backed.
This is a different type of environment for many small businesses that are even just trying to get funding, trying to get started up.
Yeah.
And the credit conditions are vastly different than they were in years prior. So what is the top kind of theme or topic that you're hearing them come to you about or even discuss amongst themselves in terms of getting financing and even getting a better credit condition for themselves?
Yeah, it really is just understanding the landscape. So where do I go to get the best rate on a loan? How do I ensure that my business is well positioned to even get that credit? What are the different types of funding mechanisms that it might not always be a loan? It could be invoice-based financing. And so there are lots of things that kind of come up in conversations to support entrepreneurs trying to scale their businesses using financing that we are able to help them navigate.
How has this sort of flow changed since you started the business a couple of years ago in terms of demand from those folks and how much of a tough time they are finding getting that advice and that financing elsewhere?
Yeah. For us, it's been consistent. I think we focus on underrepresented entrepreneurs, Black entrepreneurs, and like that graph showed, right? It's been, we had a little blip of a peak where people were really excited to support Black entrepreneurship, but we're noticing now that it's kind of going back to the norm where it's more difficult for entrepreneurs like me to get financing. So Guava has always been kind of a place for those conversations to happen.
Certainly. Walk us through the revenue model, profit. Where does that start to kind of come in for you guys? How do you kind of make sure that you're securing those margins over an extended period of time? Yeah. I'm sure a lot of investors asking you about that and what that roadmap looks like.
So we have a few revenue mechanisms. We have a Guava branded MasterCard, and so we generate revenue from that. Our membership platform has a subscription fee as well. So there's revenue that we generate there. And then from some of our partners, we generate revenue. So we have a few mechanisms to generate revenue as we support entrepreneurs doing the same.
So just to circle back quickly to the beginning of the conversation and raising capital for a business, particularly a Black startup, any key advice you would offer to other people who are trying to do this?
Absolutely. I would say use your network. It's really important to be able to connect with people that you know that can speak on your behalf. I'd also, recommend kind of doing the homework, right? Finding out the funds that invest in businesses like yours, that are investing in stages that you are at, and then using that list that you generate to get the introductions to those investors is a really great starting point. That's the method that I use as well.
Kelly Ifill, Guava founder and CEO, joining us here live in living color on set. Thanks so much for taking the time.
Thank you for having me.
Absolutely. And everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Have you tried Threads yet?
I have not. No, I have not. I hear good things though, so I'll leave it at that.
Okay, it's early days. I know I was in the tens of millions that first signed up for it, so I guess that's all I have going for me right now.
Well, if you're an active user, then you can coach me on it.
Okay, I will report back on that. A major industry shakeup is playing out in the drug supply chain. Blue Shield of California replacing CVS Health's Caremark as its main pharmacy benefit manager in January 2025. PBMs negotiate drug spending for insurers and play a major role in determining access to and the cost of drugs. California Blue Shield will give portions to industry disruptors like Amazon Pharmacy and Mark Cuban's Cost Plus Drugs. The move is expected to save Blue Shield of California $500 million annually. Joining us now is Blue Shield of California CEO Paul Markovich. Paul, you made waves with this announcement, this decision. Tell us about some of the catalysts that really drove this from the management and the executive perspective here.
Brad and Julie, thanks for having me. Good morning. When we looked at this system, it's incredibly expensive, it's enormously complex, and it's really designed to maximize the profit of the participants as opposed to the quality, cost effectiveness, and convenience of consumers. So that's really what prompted us to start from scratch and try and reinvent this system with a group of like-minded partners to simplify it and to make it much more both customer-centered and less expensive.
Paul, it's Julie here. Why is there so much extra cost, in your view, when buying through the existing model of the pharmacy benefit manager?
Well, it's just the profit motive over time. There's, at least 8 players in this chain, and they all make more money when we sell a higher volume of more expensive drugs. And a great example of this is, recently there's a prostate cancer drug that costs about $3,000 a month. It's generic. We managed to negotiate an alternative supply for $160 a month. Same drug, same compound, pretty big difference in price. And when we asked our pharmacy benefit manager to take it and sell it, they initially refused. And it took us about 5 months to finally get them to offer that drug. And again, the reason is the fees and everything that are baked into what they receive in terms of revenue and profit goes up. And that's true for all the players. And so it's very difficult to fight financial self-interest. It's a structurally inflationary system.
And so when we think about the costs that this is expected to bring down for the different health plans that are represented by Blue Shield of California, walk us through some of those costs. This is successful if, your plans and the members within those plans see what type of cost difference?
Well, yes, as I said, we expect to save about $500 million a year on about a $4 billion cost savings. So it's about a 10 to 15% savings overall. Most of that's coming out of the distribution costs. Right now, about a third of the cost of the drugs goes into this distribution system. And obviously with partners like Amazon and Mark Cuban Cost Plus, we feel like we can get to a net price with pharmacy manufacturers, make sure they're staying whole, but have the distribution costs come down dramatically. And then beyond that, by taking the incentive out of the system to sell higher volume of more expensive drugs, we think there's going to be more substitution towards drugs like the one I just mentioned at $160 instead of $3,000.
Well, sort of on a related note, Amazon and Cost Plus don't offer everything, right? So where there are gaps, where will your customers go?
Well, we're going to have all those gaps filled with all of the partners. And so it's not just Amazon and Mark Cuban Cost Plus, but all of our members are going to continue to have all the options they have today, including going to a pharmacy to pick up their drugs. They're not going to have to get them in terms of home delivery. So all of the options that they have today, including getting access to specialty drugs, all of those are going to be available to them. I think they're going to have more options, and I think better options when it comes to things like the convenience of home delivery, accessing a pharmacist through a web chat 24 hours a day and 7 days a week. But that is why we need more than Amazon and Mark Cuban Cost Plus to make this work.
There's a significant amount of patent roll-off that has made Cost Plus, that has made Amazon and PillPack and that acquisition, of course, but even furthering of the delivery on what some of the PBMs had been able to kind of corner the market for themselves. That patent roll-off has created that opportunity, and so will that further the kind of smaller players that are able to jump in or perhaps fill the gap and start to reduce some of the costs that the households are seeing in their individual spends that they have on healthcare costs and specifically on medications?
Well, that's exactly what we're hoping will happen, and we're aspiring to with this model, and would like to see happen more broadly. I think the fundamental difference you're talking about, Brad, is the difference between treating pharmaceuticals as a means to improve people's health and reduce the cost of healthcare, as opposed to seeing as a revenue and profit center. And when it's seen as a revenue and profit center, it's not necessarily the best thing either for the consumer or the system. And when you think about it as how do we get people life-saving drugs, health-improving drugs at the lowest possible cost, and all the players are rewarded for doing that, you know, the system shifts and it's able to do some of the things you just described. Take advantage of when you have patent cliffs, making sure that the most cost-effective version of that drug is available to our members.
One of the players you're working with on this is also a PBM, a pharmacy benefit manager, but it's one that's jointly owned by a number of these Blues plans. It's called Prime Therapeutics. Is the PBM model itself just fundamentally broken? And is the one that you all jointly operate different because it doesn't have that profit motive you're talking about? In other words, like, do PBMs as they exist need to go away?
Well, I think PBMs as they exist clearly need to change and change pretty fundamentally. I think you're absolutely right, Julie, when you say the system is fundamentally broken, and it's those incentives and all of the behaviors that come along with it make drugs highly and unsustainably inflationary and also very opaque. Like right now, most of the physicians that are prescribing medicines and the members that are getting them do not know the price of the drug at the time of the prescription, pardon me, or even until they go and pick the drug up at the drugstore. And I think they would all make different choices if they were fully informed. And so, yes, I think it's structurally just doesn't work. And the difference between, as I said, treating it as a way to improve people's health and improve the affordability of healthcare, as opposed to a way to maximize profit over time, is a fundamentally different approach to pharmaceuticals, and that's what separates these two models.
Paul, just lastly, while we have you, a lot of people are wondering at a household level how they can go about reducing some of their own health plan costs as they're having to adjust for where costs elsewhere within the household may have increased. Is there a successful way beyond, the moves that Blue Shield of California and executives like yourself put forward that they can go about taking necessary steps to bring down some of those costs?
Well, yes, I think that shopping is always a good thing to do. I think looking at your alternatives, both in terms of your health plan at your open enrollment period and what your benefits are versus what they cost. When you're getting into drugs, there are often alternatives. So talking to your physician and looking at what those alternatives are. I think the more that we can introduce competition into this system and let consumers look at their options and make those cost value trade-offs, I just encourage customers to do that, because let's face it, at 18% or more of gross domestic product, healthcare is just way too expensive right now. And we're trying to do everything we can to bring it down, but I think there's options for customers to do a little shopping and do that for their own pocketbook as well.
Paul, thanks so much for your time this morning. Paul Markovich, Blue Shield of California CEO. Thank you.
Thank you.
On Thursday, Japan will begin releasing water into the sea from its wrecked Fukushima nuclear plant. The country's running out of tanks for the treated radioactive water following a nuclear disaster caused by an earthquake and tsunami back in 2011. Neighbors China and South Korea are angry and concerned that the release will create environmental hazards in the shared ocean. Inez Ferre is here with more on this, as well as nuclear power more broadly. Inez?
Yeah, Julie, and this is part of a $150 billion cleanup of that nuclear plant that you're referring to in Fukushima. It was damaged. Its reactor buildings were damaged back in 2011. So why do this? As you were just mentioning, they're running out of space to store this water. It's treated contaminated water. So it's been contaminated, but it's been treated to strip out radioactive elements. But there's one element in it called tritium, which it's very difficult to separate from the water. And in very high dosages, it is carcinogenous. So how much of this water are we talking about? We're talking about an amount that would fill about 500 Olympic-sized swimming pools. Now, it's important to note that a lot of nuclear plants release water that has some low doses of radioactive elements in them, including tritium. And this is done normally, and they're called authorized releases. And what the utility company in Japan is saying is that they are going to combine this treated water with seawater to dilute it so that the levels will be far below the Japanese government standard levels and also the levels that are required by the World Health Organization. But of course, you do have nearby countries. You've got environmentalists that are saying, look, there hasn't been enough testing on this element. And also you have concerns about the perception, the fishing industry also, and the perception that this release will have.
So, Inez, further down that perception, the perception of nuclear power has shifted over the years. So what did the latest surveys show about how Americans feel about nuclear energy?
Yeah, there's a recent Pew survey, and you see the results right there. 57% of Americans favor more nuclear power plants versus 43% back in 2020. So there has been a shift in perception. Americans, though, they're still more likely to favor solar power, 82% of them, and 75% that are favoring nuclear power. Now, you have also support of Democrats and Republicans that has been increasing since 2020 when it comes to nuclear. And it's also important to note that you have some bigwigs in the industry that are talking about this as well. So you've got Elon Musk that has said that you need more nuclear because we have to go to Mars and for all the space endeavors. You have Sam Altman that has his SPAC, and that is going to be taking nuclear energy company public. But still, if you take a look at the landscape of nuclear plants in the U.S., there's 93 of them. There's also one that's being constructed right now. And so that is down from 111 back in 1990, because at the end of the day, these are still hard to sell. Look, the pro of nuclear is that it produces zero carbon emissions, but the cons is that it does produce radioactive waste and also the possibility of accidents, the risk of an accident. And many people do not want to live near these, so it's not in my backyard. They're a hard sell still.
Inez Ferre, thanks so much for tracking this survey and the results and breaking this down for us. Appreciate it.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
You're on a long road trip. What's the first album you put on?
First album, New Nation Project, Kirk Franklin. Gives me vibes, takes me back to when my family used to load up the car, go to Hilton Head, South Carolina. You'd hear Kirk Franklin's raspy, deep voice come on.
You want to give us a little?
I mean, dude, you want a revolution. Whoop, whoop. Like, that is the essence of beginning a car road trip right there. Take you back to the late 99s, early 2000s.
Mine feels a little lame compared to that.
No, you know.
I would put on Billy Joel's "A Stranger." Just like everyone, you sing along, you know the words.
Yeah.
That's a good one for me.
That's a good one.
We continue to track shares of Lowe's today. Right now, they're up more than 3.5% after the company's results came in mixed. They fell slightly short of expected sales on lower DIY demand. The company, though, did stick by its full-year forecast, having already predicted that sales will slow this year as pandemic-era demand cools. Lowe's outlook for the year echoes that of rival Home Depot, both bracing for a slowdown in home improvement. We should say Lowe's comp sales fell, but not as much as estimated. Joining us now is Max Rocklenko, TD Cowen director on these Lowe's numbers. What stood out to you from Lowe's in terms of execution here, maybe that helped it edge out the estimates, considering that the macro environment is a little dicey right now?
Yeah, thanks a lot for having me on this morning. Lowe's had good numbers. Overall, they were better than expected, both with same-store sales coming in ahead, down 1.6%. But better than what ourselves and others modeled, as well as EBIT margin, which also did quite well. The company, to your point, did reiterate guidance. So all these things are positives, and the stock is reacting nicely. Overall, the company is doing a really nice job of executing in a very mixed to tough backdrop. You mentioned that the pro environment remains better than DIY, and we are seeing pro continue to outperform.
So what does this spell out for where the company is going to be able to also maintain margins? They talked a little bit about that and what they were doing and trying to reduce expenses and making sure that they're not kind of missing out on just driving a good customer experience. But at the same time, investors want to hear about the margins. And even in an environment like this where there is a macro concern, still securitizing some of those margins top of mind.
Yeah, management has done a great job over the last handful of years of really improving operations, both at the store level as well as HQ. They're well on their way, but we still think that they have several years more to go. They previously would underinvest at times in some of their stores, some of the IT, and these are some of the major areas where they've been investing. And we are seeing an improvement in margins. Gross margin did quite well, and we're excited about some of the other initiatives that they've got going, which we think are going to help margins in the back half of the year.
When it comes to the pro business at Lowe's, they seem to have done a little bit better in contrast with what we heard from Home Depot. What do you think is going on there?
Sure. So Lowe's has done a really nice job with the pro business for the last several years. They're really looking to take market share with the smaller pros, whereas at this point, Home Depot and their initiatives are really focused on those large and much more complex pros. So Lowe's is doing a really nice job. But at the end of the day, their pro business today does remain roughly 25% of mix versus Home Depot that's at about 50%. So Lowe's is doing well, but the size of the business today does remain much smaller than where Home Depot is.
When we were comparing some of the results that came out between Home Depot and Lowe's as well, one of the areas that comes to mind within this broader inventory set and the SKUs that both of them have, they overlap in some of those kind of larger durables that a lot of consumers are not going to need, 2 lawnmowers or 2 refrigerators. Some people might need 2 refrigerators. Whatever the case may be, they're still going to have the issue of just managing that type of inventory expectation. Is there kind of a firm footing that you believe that Lowe's executives and their management team have around making sure that they are moving through excess inventory in some departments versus others where maybe they're looking to get more of that pro partnership in there, which has more of a propensity to spend on a continued basis?
The Lowe's management team during the course of the pandemic has done a really nice job of managing inventory. They certainly have a proven track record of doing this. That being said, to your point, those large discretionary big ticket items is where we've seen the most softness as the consumer does continue to pull back. We think that management will continue to do a good job of managing inventory. This is something that has been expected for some time, but the trend is decelerating. So it's certainly one of the top areas that we monitor.
Max, just lastly, while we have you, I mean, we know that there's been a shift of spending among consumers from goods to more of that thrust towards services right now. But or services and experiences. We could even kind of round that out into. But what about the in-home experience? Is there anything within these earnings results that say people are willing to still invest in certain parts of their home experience? I know it's not necessarily a service as we might think about it, but I don't know. I feel like it's a good experience when I've got my living environment up to snuff and, just able to relax at home, kick back with a beer or something like that. I don't know. How do you look at it from your perspective?
Well, I think you're absolutely right. What Lowe's as well as Home Depot's results are telling us are two things. One, the professional business continues to do really well. And all that ultimately is the homeowner hiring contractors to work on, small to medium to large size projects for them. So they're continuing to spend there. And then additionally, the homeowners themselves are spending on small DIY projects themselves. So to your point, there is still a lot of money that is going towards improving your home, your living situation. Where the pullback really is occurring is much more on that discretionary big ticket side. Things like, patio furniture, things like grills that, a lot of people bought during the pandemic. So we're all certainly continuing to spend on the home. We are just being a little bit more mindful and choiceful than we have been in the past.
True. All right. I know my pastor watches. I'm not really drinking that much beer at home. Let's be real here. Max, thanks so much for joining us here today. Max Raklenko, who is the TD Cowen director, and talking all things Lowe's for us. We appreciate it. All right, switching gears here. Some fresh rules are coming to the AI space. A U.S. federal judge has ruled that a piece of AI-generated art cannot be protected under copyright law. The decision says that only human-generated work can be covered. For more on this, we're joined by Yahoo Finance's Alexis Keenan. Hey, Alexis.
Hi, yeah. So if you had any dreams of having a company generate AI art for you and reap all the benefits and licensings of that, then, this judge is dashing those hopes, at least at this stage. It's coming from the D.C. court, from a federal court, a district court there. And the judge is saying that no, this particular piece of art, I think we have it to show on the screen there within the context of the decision, that piece of art, the judge said, it cannot get copyright protection. And this art was generated by a software that is owned by the plaintiff in this case, and his name is Stephen Thaler. And what he did is he applied for a copyright, and he said he wanted then the name of the copyright to go to the computer software, but he wanted then the rights to be derived and transferred over to him so that he could benefit from it if there was any benefit to be had. Now, that definition of whether or not something can be copyrighted has been really murky because courts across the country have been coming down with different decisions. And ultimately, in March, the Copyright Office tried to give some clarity, and they said that they would specify that they're willing to consider AI inclusive art, but that it can't be generated wholly by machine. So in this case, because the art was generated only by the computer's algorithm and the software, that the judge said no. What the Copyright Office said, so that this decision seems to be in keeping with the Copyright Office's instruction, they said a human must create a work's expressive elements. In the ruling, the judge writes this. She says, copyright has never stretched so far as to protect works generated by new forms of technology operating absent any guiding human hand. Human authorship, she said, is a bedrock requirement of copyright. Now, I look back into some of the deals so far that have taken place for AI-generated artwork. There was one in 2018 that captured nearly $500,000. So this could be a lucrative area, but in terms of copywriting and getting all of the rights that come along with that to reproduce artwork, not going to happen, at least at this stage. Maybe the Supreme Court will have something to say about it.
Really interesting. I mean, you could argue everything has a human hand because the AI had to learn from art that was created by
and a human had to prompt it.
The input, yeah. I don't know. Thanks for keeping us posted on all of this, Alexis.
Yeah, still murky waters.
Yeah, definitely. All right, Rochelle Kufo has you for the next hour of trading. Keep it right here on Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Another warning sign on the health of the consumer comes from Macy's this morning. We'll break down the retailer's earnings call. And a new employer survey is showing where priorities lie for workers as concerns around mental health arise. We'll discuss that as well. Plus, rents are falling for the third month in a row, but affordability isn't improving everywhere. An economist from Realtor.com will join me this hour. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Looking at a mixed picture here again to start the day off. Looking at the Dow here, off about 95 points or about 1/3%. The S&P 500 there, just slightly in the positive by about 1/10%. Taking a look at the tech-heavy Nasdaq there, up about 0.5%. A lot of people wondering, could the summer sell-off be over? A lot of information coming in today. And of course, looking at housing sales falling again in July. Currently at half of the pre-COVID supply, so a lot for markets to digest, and of course, earnings season. Let's also check in on the Treasury market as well, as we're just a few days away from that meeting at Jackson Hole. We're looking at the 5-year trending upwards of about 1/3%, a slight downtick there for the 10-year, but still above that 4% mark. And taking a look at the 30-year, that's also down at about 0.6%. Well, investors are hoping for a little bounce back in the market after the first few weeks of August saw a slump in stocks, but some analysts say the sell-off is only halfway done. Well, our next guest is eyeing a dip in the S&P down to 43.25. Joining us now is Jay Woods, Freedom Capital Markets Chief Global Strategist, and Yahoo Finance reporter Jared Blicker. Big welcome to you both. So I want to first have you walk us through your 43.25 scenario, especially given that we got close to that range last Friday.
Yeah. And Jay, let me set this up for you. I'm going to run charts, but you go for it. 43.25?
Yeah, 43.25. Ironically, this was the level that we got to last August before the big Jackson Hole meeting, and we failed as Chairman Powell put a little cold water on our rally. Well, ironically, we're back at that level again. 43.25. Right here, Jackson Hole, and what are we doing? We're testing it from above. So we're coming down, we're retracing. These are normal pullbacks you see in bull markets. This is a healthy retracement, and it's testing it. When you get to that testing point, you get a little nervous. We've seen some positive action. Things will slow down into Friday. I don't suspect us to break down or really bounce too far above it until he speaks on Friday. But,
yes.
Hopefully his tone is hawkish but cautious and very positive, and we go higher.
Hawkish but cautious. The 10-year T-note has been getting a lot of attention. Very appropriate that we're talking about the Federal Reserve. Although they don't control the long end of the curve directly, his words, Jay Powell, could move things. And by the way, this 4.33%, this is the highest since we've seen in 2007. Your thoughts on the current interest rate structure?
This one has me a little concerned. This is what we're watching on the floor, 4.3% high since 2007, as you astutely said. I mean, I don't know if you can go back to 2007. We can go back
20 years,
but
and there you go.
What you don't want to see is this close on a monthly basis above this area here, because what we can see is a lot of quick movement, and Powell could ignite that movement on Friday if he says something that has us in that fear that rates are not only going to continue to rise, but it could do at a faster pace than we expected.
Higher for longer.
Higher for longer. Exactly. Well said.
Something like this. Okay, let's set up the Dow here and also the transports. We've seen each of them kind of race independently. Here's the Dow, and we can see it's back down kind of to support. Looks like it's in danger of breaching that. What are you seeing here? And then in the transports?
Yeah, once again, go to good old Dow theory. We've talked about this on Yahoo Finance before. We had nice breakouts, and you're stealing my thunder. You're taking the charts for me. It's all right, Jared. But yes, it's consolidating at the area from where it broke out here. So what you want to see, you see a breakout, it pulls back where old resistance becomes support. It can consolidate here, hopefully digest, and then rally going into the year end. And now we're talking also August, September, 2 of the worst months. So these seasonal factors are kind of playing out as we expected them to.
I'm going to skip past the transports because I want to get to some stocks that are really moving today. Macy's I'm going to pull up a 3-month chart so we can really see this. This is an ugly candle. Now it's dropped back down to potential support there, but
this is what we saw last quarter. All right, so Macy's has rallied 9 of the last 11 quarters it's reported, despite missing or beating on earnings. It didn't matter. Today, what do we have? We've had a key area of support, which all of a sudden gapped down. We don't like to see these gaps. Still, the day's not over. It could rally miraculously like it did last quarter. I don't think it's going to. Let's watch this area around 12. Let's not forget, 3 years ago, this stock was in single digits. Things aren't looking good for Macy's, and I would not really want to dip in and buy here.
We got a question from Michelle. She'd like to jump in here. Michelle.
So I know that a lot of people are looking for opportunities in this space at the moment. I know you have some picks in healthcare. Surprisingly, Pfizer not making your cut though, Jay. So walk us through your base case. You've got United Health, Merck, J&J, and Amgen, but not Pfizer.
Well, I definitely don't have Pfizer. Pfizer's been a dog in the sector, and I focused on those 4 stocks. Why? Because they're in the Dow Jones Industrial Average. If you're looking for reasons why the Dow can rally, I give you healthcare. The healthcare sector continues to make higher lows as it goes along. All right, so what do we see here? We see nice continued higher lows. Every time it sells off, it continues to get a little higher, and it's consolidating in here.
Jay, I want to stop you for a second. Here's a 10-year chart, and I'm going to put some candlesticks back on. This is like I would call this a rare diamond formation. This is just consolidation in terms of a long-term secular trend, it looks like.
Well, the diamond formation could be a negative. This is a debate in the technical analysis community because sometimes this is a key reversal where you see it come down. However, yes, I do see the diamond, but the way the underlying stocks, the stocks within the index, the UNHs of the world, which is the biggest component of the Dow, because the Dow is
look
price
at United
weighted.
Health. Very similar chart to XLV. This is 10 years, but I'm going to dial this down to a year to date, and we can switch that as well.
Yeah, United Healthcare has been consolidating. It tested the 450 area here twice. And if you go back further in time, it's tested it several times. So we have a nice double bottom. It rallied above it. It's now above its 200-day moving average. And it can still run another 50 points and still be in this consolidation zone that we've seen. 50 points in UNH is another 300 Dow points. I think that's what we're going to see from it over the near term. And if you're a little skittish on the overall market, healthcare is a safety sector. So I think it's going to see some action. 2 more.
We got Merck and Amgen. I don't know if we have time for both, but start with Merck.
Let's focus on Merck because Merck is playing out seasonally just like it had last year. We had some consolidating periods where we've seen drop-offs. And what has it done? It's rallied year-end. The stock is flat year-to-date. Over the last 12 months, it's up about 25%. But year-to-date, it's flat. If people are looking for performance, if they're looking for something strong within the sector, it's not only in the Dow, it's a major impact on the XLV, and the stock should rally into year-end based on what we've seen before and the fact that it's still making higher lows. I'm not very good at drawing with my finger, obviously.
That's fine.
But it looks like in this consolidation period above 105, I still like Merck, and I think it's still bullish.
All right, Rochelle, any more?
Well, I was going to say, for people who are perhaps not familiar with some of the terms like diamond formation, what is the best way for them to sort of view some of the changes that they're seeing here?
Love it. Trader education.
Trader education, risk management, obviously rule number 1, number 2, number 3 when trading. When you get into the trade, you want to have levels. If this doesn't work out, like I just said in Merck, 105, something has changed to me, and I will take that loss. I will limit that loss. The formations are fun to follow, but I look for continuation patterns, and I'm seeing setups that can show continuation to the upside. So the risk-reward setup to me in these stocks and in the sector is definitely bullish.
Jay, we got to go. Really appreciate you. Anybody who wants to learn about trading, also follow Jay Woods on Twitter, your handle.
At JWoods3.
There you go. Rochelle.
I've absolutely loved seeing you guys go off on the technicals. It makes my heart very happy. A big thank you there to Jay Woods, Freedom Capital Markets Chief Global Strategist, and our very own Jared Blickery. A big thank you to you both. Well, as you heard, their shares of Macy's under some pressure this morning after reporting second quarter results. It beat on its top and bottom line, but investors don't seem happy. Well, our very own Brooke DePalma listened in on that earnings call and has the lowdown on what is driving the stock down this morning. Hey, Brooke.
Good morning, Rochelle. That's right. This is the largest intraday drop since June of 2022 following this earnings call with executives this morning that painted a cautious outlook on the second half of 2023. Some key takeaways from that call. We did see same-store sales decline down 7.3%. And while that was better than analysts expected, customers are continue to shy away from items that they bulked up on during the pandemic. That includes activewear, casual, and sleepwear. that drove those same-store sales to continue to decline. They did say, however, that categories like beauty as well as fragrances and the high-end makeup cosmetics do continue to do well. Meanwhile, Bloomingdale's business did come in same-store sales decline there, but less than the overall same-store sales report. They said that they're really focused there on being the winning option for multi-branded upscale retail. A highlight at Bloomingdale's is their outlet locations continue to outperform. And later on this month, they're opening up their 21st outlet. Now, moving along to perhaps the biggest surprise of this report is that decline in credit card revenue. That came as one of the biggest surprises across multiple reports from analysts on the street this morning. That was down $84 million from last year. Now, the CFO rather said that they had expected delinquencies to rise, but it happened faster than they had predicted back in Q1. They also said the speed of those delinquencies across all age balances accelerated after that first quarter report, especially in June and July. Now, the CFO did add that the team is working to mitigate the impact of this with its partner at Citibank, and so perhaps that is a telling sign of something that we'll look out for in Citibank's upcoming third quarter results. And in addition to that, a bright spot of the report, they did say that one of their five growth vectors is that new smaller format that continues to outperform. They now have 10 smaller format locations, and they plan to open 4 new store locations with this smaller format later on this year. And so lots to digest in this report, but really doubling down on where the consumer is at.
So, Brooke, how does the company see macroeconomic conditions impacting the consumer?
Yeah, absolutely. Well, they did reiterate their guidance here, and they now expect net sales to be between $22.8 billion and $23.2 billion to round out the year. But the CEO telling investors on the call once again that they are taking a cautious outlook when it comes to the consumer on the back half of this year. They continue to highlight the pressures that they're seeing. They did identify who exactly their consumer is. They said that it's roughly 50% with an average household income of $75,000 and under. Now, the CFO also didn't shy away from the headwinds that the consumer is up against. Take a listen.
So the macro environment really is having the lion's share of the impact on credit and is a real indicator of where we think the health of the consumer is and supporting our cautious approach. The one metric we find quite interesting is the debt service ratio, which we leverage as a proxy for the consumer's ability to pay debt using their disposable income, personal income. So this is about credit card balances. This is about student loans, which we know is going to come into focus in the next month or two, auto loans, mortgage. So we just believe that the customer is coming under pressure because these are new realities that they have to continue to deal with as we get through the back half of this year and move into next year.
Now, this is something that we also heard from other retail brands like Target and Home Depot, all these headwinds up against the consumer. And so you think about the vibe check of this call, well, not so good. It's actually pretty bad about when you think about the headwinds that the consumer is up against, when you think about those that are going to Macy's for the back to school shopping season, and when you think about that holiday season, especially they also mentioned Halloween even rounding out, the back half of this year. There's lots of different headwinds that are impacting consumer spending that Macy's is very aware of. And so bad, but maybe it'll get better next year, Rochelle.
We'll certainly see that holiday spending season will be a key one because, as we mentioned, starting to see some cracks there for the consumer. Great stuff. Appreciate that breakdown for us, our very own Brooke de Palma. All right, well, I'm watching shares of Tesla as it comes back to life this morning, up about 1.5% at the moment. The stock rising for the second consecutive day of trading. That's after a sell-off following the EV maker's second quarter earnings release. Now, investors were wary of the pressure price cuts put on the company's margins after they fell again in the company's second quarter. The company also faced increased competition in China, adding to some post-earnings pessimism as well. Now, following new price cuts in China on the Model Y and S vehicles, Tesla saw insurance registrations in its second largest market rise to 13.9 thousand last week. As for the stock year to date, it's up about 90%, so investors probably aren't too worried despite some of the drag this summer. All right, stay with us. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Have you tried Threads yet?
I have not. No, I have not. I hear good things though, so I'll leave it at that.
Okay, it's early days. I know I was in the tens of millions that first signed up for it, so I guess that's all I have going for me right now.
Well, if you're an active user, then you can coach me on it.
Okay, I will report back on that.
A new large employer survey shows concerns over mental health, cancer and chronic disease are top of mind as the cost of providing health benefits for employees is set to increase about 6%. Now that's a historical high according to the Business Group on Health. The company represents 152 large employers who are responsible for a combined 19 million lives. Here with more is our very own Anjali Kemlani. Hey, Anjali.
Hey, Rochelle, really interesting results from that survey this morning. Of course, mental health front and center in terms of cost. That is something we've seen trending from the pandemic times as more employers are looking for solutions to provide to their employees. But a couple other things kind of struck me from this survey. One, GLP drugs, those weight loss drugs that are everywhere these days, really front and center for the companies, concerns about the cost. And the employer survey did look at whether or not they are covering them. 92% said yes, they were covering for diabetes or would be in the near future. Meanwhile, only 46% said they currently are covering for weight loss, with a 13% saying they're considering it for 2025 and 2026. I did ask if they were given the option of saying no, and those results were not revealed. However, 53% of respondents did say that the cost of those weight loss drugs is a concern. And generally speaking, cost is top of mind. Of course, 6%, as you mentioned, is that increase in cost trend. A little blip on the radar, of course, during the pandemic, 8.2% increase in 2021. But outside of that, this 6% is quite a jump. Mental health contributing, potential long COVID impacts, even though 39% said they don't see or don't expect an impact. And 41% looking at chronic conditions, and that includes those weight loss drugs. But also what was interesting was this look at policy in the PBMs. We know, of course, California Blue Shield really creating a shakeup in its announcement of unbundling its PBM providers from CVS to a number of them, including Amazon Pharmacy and Cost Plus Drugs. So that trend could continue. The surveyors did say that they saw discussions about unbundling from these employers. So we could see more announcements like that in the future as employers weigh how to bring down costs, especially as more expensive and novel therapies come to market. So that's where things stand right now for the upcoming year.
And do we know, especially if we look at that number for mental health, about any sort of expanded coverage or perhaps better availability of providers in that space?
Well, the providers is something they definitely don't have control over, but are concerned with, which is why there has been an effort to kind of take on the cost, especially for out-of-network options. They've mentioned that they're also looking at telehealth and those type of providers. So that seems to be sort of where things are in terms of what the options are available. We, of course, know there's a shortage of providers, but telehealth, virtual options, navigation, those are where you see a little bit more support. And as you can see on your screen, you know, the areas where there is improved costs or concerns for costs. So a lot for them to really consider when it comes to the variety of challenges that come with within the umbrella of mental health. And that's something that is a new additional cost burden for employers. One really quick point of data, the burden that employers are taking on has also increased in that premium cost. They're covering a little bit more than $11,700 in premium costs for the employers alone, and trying to take on more of that shift as costs increase. And that's a jump from about $10,300 last year. So as you can see, costs are just going in the wrong direction. And one of the officials from the business group called costs daunting for employers. So definitely a lot on the plate as we try and look at, the broken healthcare system in this country.
Certainly appreciate you breaking that down for us, Angelique Kimlani. Thank you so much. Well, shifting gears now, the Jackson Hole retreat is set to begin Thursday, and investors are slowly turning their attention to Wyoming, where Federal Reserve Chair Jerome Powell will give his speech on Friday. Particular areas of interest are, of course, the Federal Reserve's intentions in the short and long term, as the U.S. economy still struggles to get down to that 2% inflation mark. Let's bring in American banker staff writer Kyle Campbell to discuss this more. So, of course, going into Jackson Hole, what do you think the expectations are? A lot of focus here as we are in a very tentative place here for the Federal Reserve.
Hey, that's right. And thanks for having me on, Michelle. The expectations here, at least my expectations, are for Jerome Powell to reiterate that the job is not done here yet, to say that the Fed is going to continue doing whatever it takes to reach that 2% target for inflation. But I expect him to do so in a much more sort of moderated manner than he did last year when he gave that, somewhat terse 8-minute speech, which sort of clocked in at about 2,000 words, roughly, half the length of his normal speech at Jackson Hole. So he's going to probably take more of a moderated approach to tell markets that, the job is not done. We're going to continue doing what it takes, and including holding rates longer, as long as they need to be held high. But he might also indicate that there's going to, that there's going to be less pressure for another hike at the September meeting, and I think that's sort of the expectation. Most people on the street are sort of predicting a sort of a hold or a pause next month, and so I think the nuance is going to be, of course, how he conveys that message, letting markets know that more tightening is to come, but maybe not in the immediate next meeting.
And as we know, the banking crisis that we had earlier this year did some of the tightening work for the Fed. As we talk about some of the capital reforms here, I know you've been honing in on some of the rule changes that came alongside the Basel III Endgame proposal. Break that down for us and what we should be paying attention to there.
Yeah, absolutely. This is something that banks have been looking forward to for a long time. We finally now know what those rules are going to look like. It's funny, before this past year or so, there was an expectation that these reforms would be capital neutral, but over the course of a change of administration and recent events in the banking sector, it became pretty clear that that idea would be out the window. And now we know that there will be an increase in capital requirements for virtually all banks or all manners of banks above $100 billion of assets. And that's sort of been picked through in a number of ways. But one thing that I've been sort of honing in on this week is another proposal. It's not capital related, but it could be impactful for a certain set of banks, which is sort of large foreign banks. And this actually came tucked into the GSIB surcharge proposal that the Fed introduced alongside the Basel reforms. And this is was presented as a technical change to the GSIB surcharge, but with it comes a new reporting standard that's going to change the types of assets that are going to be counted towards a bank's cross-jurisdictional exposure. And essentially what that's going to do is it's going to put about 7 banks and 2 intermediate holding companies into a higher tier of regulatory oversight. And that's not going to come with an additional capital charge, but it will come with additional costs in the forms of compliance, particularly around liquidity reporting, stress testing, and sort of various other compliance-related requirements that come with that category shift.
So with that category shift and then obviously the tightening that we're already seeing from the Federal Reserve, how should investors be viewing the banking sector at the moment? Yeah, I mean, I think the big takeaway, that I think investors should have, from the banking crisis is that, balance sheet management is important. Especially as rates are high and continuing potentially to tick higher. Banks have to make sure that they have a positive net interest margin. And of course, this week we saw some banks that have struggled with that. Actually just this morning, S&P downgraded a handful of regional banks that are struggling with outflows of deposits and sort of an over-reliance on brokered deposits, Comerica, Valley National, and a few others. So I think if you're investing in the bank space, you have to sort of be mindful of how banks are dealing with these rising rates, and if they're able to capitalize on them in the form of a higher net interest margin through higher loans, or if they're having to pay more for their deposits and therefore realizing fewer profits. Certainly we'll be keeping an eye on that. Appreciate you joining us this morning. American banker staff writer Kyle Campbell, thank you so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
We've seen the S&P 500 pull back a little bit from its highs, around 2.5% or so. How deep do you think that drop could be?
Yeah, if you'd asked me a couple months ago, could we get back to the lows that we saw at the end of last year? I'd say maybe. I don't think that's going to happen now. Maybe another 5% pullback or so to consolidation phase, maybe around 4,300 on the S&P.
The creme de la creme for car collectors, Pebble Beach Concours d'Elegance, the annual gathering of rare, antique and international motor cars, took place over the weekend. Car enthusiasts all over the world showed up, including our very own Pras Subramanian. He joins us now. So Pras, set the scene for us. What was the event like?
Hey, Rochelle, yeah, lots of action there in Monterey over the weekend. We saw a 1937 Mercedes win Best of Show there at the Concours d'Elegance, and around $400 million in classic car sales at auction. But it wasn't just classic cars on display on the 18th green of Pebble Beach. We saw a number of automakers announce new cars during the week, from Lamborghini to Mercedes. Even Acura had an EV. One company that had a presence was Lucid Motors. Lucid's Air EVs were everywhere, shuffling attendees around and offering test drives to various people. Now, though a new car was not on display, CEO Peter Rawlinson told me the recent price cuts of the Air sedan were working, and that Lucid's upcoming EV, the Gravity SUV, was going to debut soon. Here's what he had to say.
We reverted to our original pricing, which I think we got about right. We hit some really inflationary challenges, particularly in batteries, as we got into the summer of 22. We had to take a price action accordingly, but I'm delighted to say we're back to our original pricing structure, and that's been so well received by customers and the market alike.
And so you mentioned the call, the second quarter earnings call, that you're seeing a lift in orders. Is that correct?
It is true, yes, absolutely.
You can't speak to that, how much, how little, or is it significant?
We'll have to wait for our Q3 earnings for that, I'm afraid.
I tried.
We're going to have a real launch event, an unveiling this November. So watch this space. There's going to be a world premiere, and I'm really excited. We've got the Alpha prototype fleet running around. We've got 30 or over 30 cars driving around right now. The dynamics are really exciting. This is going to be a 7-seat, 3-row, all-electric SUV, truly state-of-the-art. And I'm really excited at the prospect of unveiling this to the whole world this November.
So we knew that Gravity SUV would be revealed sometime this year, but now we're getting a timeline of November.
So Pras, I have to ask you, your favorite car that you saw at Pebble Beach this year?
I saw a number of amazing cars. They had the Cannonball Run Lamborghini Countach at Pebble Beach 18th green on Sunday. But I got to say, I saw there was a Porsche sort of anniversary there for the 959, a very special 911, came out in the early 90s or so. It's one time that I was a young child back then, and I used to have that car as a poster on my wall, and I love that car. And to see that, a group of them in this, we're talking about 10 of them in one place, absolutely incredible.
I usually like a vintage Daimler, but I mean, there were so many gorgeous cars. I'm so jealous that you got to go, and I will be living vicariously through you as always. Our very own Pras Subramanian. Thank you so much.
Thanks.
Well, a number that is often referred to as a driving force in inflation is a person's annual wage. And wages are on their way up as employees ask for more to combat those rising prices. In fact, the average reservation wage, that's the minimum acceptable wage offered to switch jobs, has hit a record high, hovering just below $79,000. That's according to the Federal Reserve of New York's latest employment survey. Well, with that in mind, that's an 8% increase from a year ago and a 22% increase over the past 3 years. Now, even there, the gender wage gap persists. While women's wage expectations have risen 11%, twice as fast as that of men, men are still asking for a reservation rate of about $91,000 compared to women who are expecting around $66,000. Now, even though the number of job seekers saw a decline to 19.4% from 24.7%, job openings have fallen to 9.5 million. And the number of people that are likely to work beyond the age of 62, well, that declined to 47.7%, the lowest reading since 2014. Now, the sum of all the data still suggests that, at least for now, policymakers have more of a reason to keep interest rates higher for longer. Certainly something the markets are hoping that doesn't happen. Well, speaking of that, we'll have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
We've seen the S&P 500 pull back a little bit from its highs, around 2.5% or so. How deep do you think that drop could be?
Yeah, if you'd asked me a couple months ago, could we get back to the lows that we saw at the end of last year? I'd say maybe. I don't think that's going to happen now. Maybe another 5% pullback or so to consolidation phase, maybe around 4,300 on the S&P.
Sales of previously owned homes fell 2.2% in July from the month before to an annualized rate of 4.07 million. That's according to the National Association of Realtors. Yahoo Finance's Danny Romero has those details for us. So Danny, should home buyers be worried?
Rochelle, let's put it this way. The housing activity in the resale market hasn't been this bad in over a decade. Like you factored in, sales of previously owned homes dropped 2.2% in July to that annualized rate of 4.07 million, the NAR reported. This is the slowest sales pace for July since July of 2010 and the third lowest sales pace in the current housing cycle. Well, what are the factors weighing into this downturn in the housing activity? Well, there are two: inventory and mortgage rates. The share of homes available for sale at the end of July hit over 1 million units. That's still down 14% from a year ago. This also comes as mortgage rates flirted around that 7% all month long, and now mortgage rates climbed over 7%, pricing out buyers. Plus, prices of homes have increased nearly 2% to over $406,000. So who's buying these homes? First-time home buyers remain on the sidelines, but they're also still holding their footprint, making up 30% of the sales in July. Individual investors and second home buyers purchased 16% of the homes, and all cash buyers made up 26% of the transactions. Rochelle?
So Danny, of course, it's all about location. So what about the sales regionally?
Rochelle, the West posted a gain. Sales in that region climbed about 3%. Prices in that area, in that region, also stayed pretty much steady around that $600,000 mark. But I will say this region also saw price declines over the last year. So people are viewing this as an opportunity to get in. The Midwest, the South, the Northeast, those all posted a drop in sales. The Northeast had the biggest drop. They dropped around 6%. This region tends to be a little bit more volatile, also because of the smallness of this region as well. But the story still continues to hold ground that this is an inventory issue. And these days, the newly built home market is really the story there. That is what's keeping the housing market somewhat of afloat. Home builders are really capitalizing on the mortgage squeeze and the housing shortage. Rochelle?
Indeed. Our very own Danny Romero. Great insights there. Appreciate you joining us this morning. Well, let's talk renters now, because renters across the U.S. are getting some relief. Prices are falling. Median rent prices fell for the third consecutive month, according to Realtor.com. Our next guest says it will be very unlikely to see a new peak in rents this year. Joining us now is Danielle Hale, Realtor.com chief economist. Thank you for joining us this morning. So as we saw there from the housing data, but what about for rents here? Is perhaps the worst, the peak of these high rents, is that now behind us?
I do think we've seen the peak rent price for 2023. We're at the point in the season where we typically see rents decline, and rents are down from a year ago as they have been for the past few months. And so that means we are likely to see that 2022 was the peak for rents, and we're starting to see some decline. Now, it's important to keep in mind that these are asking rents. So these are for landlords who are advertising vacant units for rent on Realtor.com. So it's not necessarily the same thing as the broader pool of rent paid by all renters across the U.S., which is measured in the CPI. So this metric that we track tends to move a little bit faster, which is why we're seeing declines here, even though the measure for CPI inflation, for shelter inflation in the CPI is actually still going up.
And as we have this graphic up here, I mean, in terms of the types of rents that are dropping the fastest, they do seem to be following a similar pattern. But then we actually did see a significant change when it came to rents for studio apartments.
Yeah, so studio rents saw the first decline that they've seen in quite a while. They had performed better. If you think about the number of households that delayed formation over the past couple of years, they're now starting to get back out. People are very keen on affordability with rent prices still close to long-term highs. And so studios have sort of performed better over the last few months. By contrast, larger units have seen rents come down faster. But if you take a big step back and look now compared to pre-pandemic, we continue to see that the 2-bedroom units and 1-bedroom units, so those larger units, have had the biggest cumulative rent increase over that period of time. In fact, 1-bedrooms are up almost 25%, 2-bedrooms are up more than 25% compared to July of 2019. So it is pricey to rent a home. We're starting to see the momentum shift, but it's a small bit of relief on top of years of higher prices for renters.
And when people are looking at some of these regions, in terms of where the rental markets that have a higher rental burden than, say, a third of your salary, what are some of the hot spots that we're looking at?
So areas like Miami, major cities where rents have gone up a lot over the last couple of years, people are spending more than 30% of their income on rent for the typical household and the typical asking rent, which is generally what the Department of Housing and Urban Development would consider cost burden. So a lot of your typical families in these markets are cost burdened. On the flip side, areas in the South and Midwest tend to be more affordable. Oklahoma City is once again the most affordable market. If you look at not just the dollar amount that people pay for rent, but also rent compared to income. And then other markets in the Midwest like Columbus and Minneapolis, St. Paul, Cincinnati, and Kansas City. So that part of the country where we see affordability is where a lot of renter interest has been going. And in fact, even though those areas are affordable, we're also seeing prices go up faster there. So some of that affordability is starting to be eroded, making it really challenging for renters across the board. I think because of that, we're going to continue to see interest from renters who want to become homeowners and potential first-time buyers. As Danny noted, we see that 30% of home sales in the last month were from first-time home buyers. So that's going to be an important channel. Fortunately, some of the savings that renters are going to be able to realize on rent will probably help them accumulate savings for a down payment a little bit faster and maybe better be able to realize those dreams of homeownership.
So then as we look at some of the things that are bringing rental prices down, including, of course, the supply of rental properties there, how much more is also needed then to meet the current demand?
Yeah, so we have a housing shortage when we're looking at single-family homes for sale or multifamily homes that are typically built for rent. Fortunately, builders have been working to build and increase the supply of housing against that shortage, but it's a substantial shortage. Our estimates range from 2 to 6 million homes that we are underbuilt over the last decade, kind of depending on the assumptions that you make. And for comparison, we build about 1.4 million homes every single year. So it's a several-year deficit that we need to build out of. Fortunately, especially on the multifamily side, we saw a record number of multifamily units under construction. It takes a while for those to go from start to completion so that they're move-in ready, but we expect to see those hit the market in the later part of 2023 and stretching into 2024. That's one of the reasons that we expect this relief that we're starting to see in rent to continue as we move into 2024.
Well, certainly at least some welcome news for renters who are sort of stuck on the sidelines, still waiting to get into perhaps their first home. We appreciate you joining us this morning. Danielle Hale, Realtor.com Chief Economist. Thank you so much.
Absolutely.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What is your favorite chart or indicator that you're watching right now?
Well, I think I'm watching jobless claims. This is something that is very immediate, and this is something that is really a good real-time indicator of what is happening in the labor market, and the labor market is what we need to really focus on. As inflation is declining, the Fed will be watching the labor market much more closely.
Blue Shield of California is replacing CVS Health's Caremark as its main pharmacy benefit manager in January of 2025. Now, PBMs negotiate drug spending for insurers and play a major role in determining access to and the cost of drugs. Blue Shield of California CEO Paul Markovich joined Yahoo Finance's Julie Hyman and Brad Smith earlier. Take a listen.
You know, when we looked at this system, it's incredibly expensive, it's enormously complex, and it's really designed to maximize the profit of the participants as opposed to the quality, cost effectiveness, and convenience of consumers. So that's really what prompted us to start from scratch and try and reinvent this system with a group of like-minded partners to simplify it and to make it much more both customer-centered and less expensive.
Paul, it's Julie here. Why is there so much extra cost, in your view, when buying through the existing model of the pharmacy benefit manager?
Well, it's just the profit motive over time. There's, at least 8 players in this chain, and they all make more money when we sell a higher volume of more expensive drugs. And a great example of this is, recently there's a prostate cancer drug that costs about $3,000 a month. It's generic. We managed to negotiate an alternative supply for $160 a month. Same drug, same compound, pretty big difference in price. And when we asked our pharmacy benefit manager to take it and sell it, they initially refused. And it took us about 5 months to finally get them to offer that drug. And again, the reason is the fees and everything that are baked into what they receive in terms of revenue and profit goes up. And that's true for all the players. And so it's very difficult to fight financial self-interest. It's a structurally inflationary system.
And so when we think about the costs that this is expected to bring down for the different health plans that are represented by Blue Shield of California, walk us through some of those costs. This is successful if, your plans and the members within those plans see what type of cost difference?
Well, yes, as I said, we expect to save about $500 million a year on about a $4 billion cost savings. So it's about a 10 to 15% savings overall. Most of that's coming out of the distribution costs. Right now, about a third of the cost of the drugs goes into this distribution system. And obviously, with partners like Amazon and Mark Cuban Cost Plus, we feel like we can get to a net price with pharmacy manufacturers, make sure they're staying whole, but have the distribution costs come down dramatically. And then beyond that, by taking the incentive out of the system to sell higher volume of more expensive drugs, we think there's going to be more substitution towards drugs like the one I just mentioned at $160 instead of $3,000.
Well, sort of on a related note, Amazon and Cost Plus don't offer everything, right? So where there are gaps, where will your customers go?
Well, that we're going to have all those gaps filled with all of the partners. And so it's not just Amazon and Mark Cuban Cost Plus, but all of our members are going to continue to have all the options they have today, including going to a pharmacy to pick up their drugs. They're not going to have to get them in terms of home delivery. So that all of the options that they have today, including getting access to specialty drugs, all of those are going to be available to them. I think they're going to have more options, and I think better options when it comes to things like the convenience of home delivery, accessing a pharmacist through a web chat 24 hours a day and 7 days a week. But that is why we need more than Amazon and Mark Cuban Cost Plus to make this work.
There's a significant amount of patent roll-off that has made Cost Plus, that has made Amazon and PillPack and that acquisition, of course, but even furthering of the delivery on what some of the PBMs had been able to kind of corner the market for themselves. That patent roll-off has created that opportunity. And so will that further the kind of smaller players that are able to jump in or perhaps fill the gap and start to reduce some of the costs that the households are seeing in their individual spends that they have on healthcare costs and specifically on medications?
Well, that's exactly what we're hoping will happen, and we're aspiring to with this model, and would like to see happen more broadly. I think the fundamental difference you're talking about, Brad, is the difference between treating pharmaceuticals as a means to improve people's health and reduce the cost of healthcare, as opposed to seeing it as a revenue and profit center. And when it's seen as a revenue and profit center, it's not necessarily the best thing either for the consumer or the system. And when you think about it as how do we get people life-saving drugs, health-improving drugs at the lowest possible cost, and all the players are rewarded for doing that, the system shifts and it's able to do some of the things you just described. Take advantage of when you have patent cliffs, making sure that the most cost-effective version of that drug is available to our members.
That was Blue Shield of California's CEO, Paul Markovich. Well, that's it for now. I'm Rochelle Acutha. I'll be back with you at 11 a.m. Eastern. Stay with us on Yahoo Finance.